What's up, everybody? How's everybody doing? Hope everyone's doing well. My name is Victor, and this is my free trading course for beginners. Give you guys a little bit more context on why I'm doing this is mostly to test myself, and also I want to teach everybody, but also to see where I am in my journey. I go with the logic that if I can't teach in a very simple way and people could be able to digest it, then have I really mastered it? So in this video, hopefully it's not too long. It's short and sweet. Quick disclaimer, I know I said that I hope it's short and sweet. Did not accomplish that, but it's okay. I recommend for you guys to watch this video at 1.5 2x speed. I want you guys to keep in mind also, I am new to speaking about all this stuff and teaching all this stuff, right? It makes perfect sense to me of what I'm talking about, but it might not be conveyed properly to you guys. That's why I might be talking a little slow. So I've already watched the whole thing, 1.5 speed, 1.75 is fine. I'm gonna break down the video so it's easy for you to come back because you guys are not gonna watch the whole thing in one go. It's extremely long. But yeah, see you guys at the end. We're gonna go over no fundamentals. This is strictly just reading price action and TA. So I'm gonna assume that you guys are already familiar in how to navigate TradingView, and I'm not gonna go over the types of trading options, futures, none of that. In this course, we're gonna go over pretty much how to read the logic of the simple thing of trading, the bare basic trading strategy: buy low, sell high. Sounds very simple, but a lot of people mess it up. But it's just going to be giving you the basic fundamentals on how to read price action on the chart, and so you know what you're looking at. And it's just, as a beginner, it's a lot to navigate as somebody new. So my main what we're going to go over is candlesticks and time frames, basic TA and strategy, risk management and trade management, trading psychology, and I'm going to give a couple final tips at the end. All right. So, all right. So the first lesson is candlesticks. I'm going to assume that you guys already know how to use TradingView. This is not going to be a TradingView video, but for my specific chart, the white candles are the up candles and the black candles are the down candles. Pretty self-explanatory. And for candlesticks, the reason why it's important to know the terms and how to read a candlestick specifically, because later on in the course, that's going to be one of the things we use to find key levels and put it into our strategy. But the basic anatomy of a candle is this. So it's white, so there's an up candle. So the reason why it's, whoops, I have this wrong. Sorry, guys. Let me just fix this. Okay, so an up candle, the reason why it's an up candle, mean a buying candle, is that it opened here and it closed above the price. So if you look at it here closely, this candle closed down. This is the close, which we're gonna go to over to the bearish. But the reason why the next one was an up candle, because since this was the close, that means the next up candle, that's the open, which this is the open. And in the next daily price action, it closed right here. That's why it's an up candle. It closed above where it opened. And for a bearish candle, it's the same thing, meaning a down candle. So just same thing, just switch these two. Just switch these two. That means it opened up here and closed down here. And the wicks is obviously the high and the low. So pretty much meaning in this down candle, even though it opened here and it closed down here, inside this daily price action, it went up to this high and to this low. That's pretty much what the wicks mean. Okay. And to give you guys for the higher time frames, if you pay attention, if you look back at in time, and if you stay trading these markets and getting that market experience, the damage is done with these wicks. These huge wicks, especially on the higher time frame, like these do damage. This is where you kind of want to buy or do your trading for most of the time when you're trading higher time frames. But the wicks do damage. That's why you need to pay attention more towards bodies. Bodies have a little bit more weight. But anyways, so that's pretty much it for candlesticks. And yeah, The reason why this is important again is to later on in a course, we're going to go over our strategy and how to find key levels. And knowing the candle high, low, the open and the close is important to find some of these zones where there might be a lot of interest to look for a trade or for whatever. So this is why we're going over candlesticks. Time frames is pretty much what the candle is telling you. So if you're on TradingView, I'm on the daily, meaning each candlestick is a day's worth of price action. Zoom in 4 hour means each candle is 4 hours worth of price action. Pretty simple, self-explanatory. You're just zooming in and gathering more data, right? Same thing when you zoom out. Zoom out, less data, but it's a little bit less noise. It's kind of a clear uptrend. Once you start getting better at trading, time frames don't really matter. Um, a lot of people say that they do for the specific time of trading, which I agree. Of course, if I'm looking for a long-term investment, I'm not going to be getting into the 1 minute, like it's obvious, but um, you should be able to use every time frame towards the end. But as a beginner, I would definitely suggest just sticking to a few. So this is kind of like a little guide that I would suggest people. You don't have to follow it, but it's what I think it's good for the type of trading you want to do. So in this course, I'm not gonna. This is not a day trading course. This is not a investing course. This is not. Um, this is not a specific type of trading at all. I'm trying to teach you how to read price and. Sorry, let me fix this. I'm trying to teach you guys how to read price action and see the idea of buy low, sell high. This way of trading works for any type. If you want to do options, if you want to do futures, anything like that, spot trading, same thing. But with that being said, I have these four types of trading on the time frames that you should use depending on you. But on this course, I'm gonna be teaching more on the strategy part, meaning it's gonna be swing trading, which is gonna be trades that you hold for a day, a few days, maybe for the month, few weeks. You're looking for that move for either a weekly move or a monthly move. Um, but here's a four. Investing is self-explanatory. Your long term, which is looking to hold this for multi-month, maybe 2 years hold, which and this type of trading, I would suggest looking only at the 1 month to the weekly. And when you want to enter a trade, um, the daily time frame. And and you might say like, why would I want to zoom in to enter a trade? Like, let's zoom out on the weekly real quick on Bitcoin. Um, why you should always have an execution time frame and a identifying zones of interest on the higher time frame, which that's why on the monthly and the weekly it's ta, that is your analysis time frame, which on the daily that's your execution when you that's the time frame when you're looking to buy um, once price hits your zone. But we're going to get into that later on the strategy part. But let's say this is a weekly. This is an order block, which we're going to get it later into the strategy part. Order block, boom, price tapped it. Zoom in on the daily now. Okay, this is an area where I want to go long, meaning I want to buy so I could get like sell up here. Um, oh, tap the order block, break a structure. You could probably start looking for longs, TP down here, first TP here, and then just hold for the rest. Simple trade that you could kind of do right now. I mean, I'm getting too ahead of myself, but Bitcoin looks like a good long area right now. Pretty decent risk to reward, not bad. But that's why you have two types of time frames. Your analysis, because I saw this on the higher time frame. Like, okay, order block. I'm gonna wait till price touches here. Oh, it touched. Zoom in. Okay, that's why we have the analysis time frame and the execution time frame. So with that being said, let's bring all this shits back up. Okay, so for investing, obviously multi-month to year, 1 month to week. Execution on the daily. Swing trading is what I said before, which holding for days, week, looking for that weekly move or monthly move, which is on the weekly to the daily time frame for your analysis, and your execution on the 4 hour to the 1 hour. Day trading, self-explanatory, what a lot of people want to promote is you're looking for the daily move. So for the daily move, TA is 4 hour to the 1 hour, execution 1 hour to the 15 minute. Scalping is you're looking for small moves, um, which is like more high frequency trading, which is harder. The lower in time frames you guys get in, just know that it's harder and you're more likely to um, experience losses. Um, so I wouldn't suggest, unless you're that type of person that likes to shoot from the hip and knows how to cut losses. But as a beginner, it's really hard to know when to cut a loss. So I don't suggest this. I like to, if I could go all over again, I will focus on the higher time frames, maybe swing, move to day, and then scalping. But that's just me. So 1 hour, 15 minute execution, 5 minutes to the 1 minute. Remember, you don't have to marry this idea. You don't have to do it this way, but this is just like just a guide, right? Um, the end goal, once you're done with your training journey and you've learned your strategy and you learned everything you need to do, you won't need the specific time frame to do any analysis. You could use all of them. Like I use all the time frames. I use 1 minute, 2, 3, 4, 5. I use the 45, 3 hour, 4 hour, different ways of using it, but that's later on once you understand price action more and understand why price moves the way that it does. Another thing before we move on, these type of trading, the lower you're going to price, yes, you can make more profits sooner and faster, but you could witness losses sooner and faster. So when you're looking at these higher time frames, at the time frame you're looking at, like for example, if I'm doing TA on the monthly and the weekly, and that's your TA time frame that you're doing, and that's the time frame that you're going to execute, expect you're not going to see a return on investment in a month from now, maybe in a week, if it's like you bought at the perfect time and it went straight up. Swing trading, you're not going to see a return the next day. Maybe you do, maybe you're that good, do something about it, take profit. Day trading, obviously you're trying to see a return that day. Scalping, you're trying to see a return in less than 30 minutes. That's your goal. Okay, like if you're in a scalp trade, the reason I'm saying that, if you're in a scalp trade and your trade is an hour long, 2 hours long, you're better off just cutting it. If you're in a swing trade and this was supposed to be a weekly move and it's been 4 months and there's it's either it's going sideways or it's going against you and you're like, no, 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 I'm gonna keep holding, you're better off cutting it because it's most likely gonna go to your stop loss or your liquidation, which that's not what we're gonna get into today, if you don't know what that means. But the reason I'm saying that is so you could have a time frame of expectation of return, and also to help you like, yo, I've been in this trade for too long. If I've been in this trade for too long, that means I'm probably in the wrong trade, depending on your trading style. You know what I mean? Like we're gonna get into the strategy and the TA portion of the course and how to read price action. So real quick, the examples I'll be giving in this course is going to be catered for swing trading, and the reason why I chose that is I'm catering towards the beginner that might be watching. I don't know your situation. I don't know if you could spend all day or spend a lot of hours throughout the week to learn this full time, right? So, for people that might have school, work, or other responsibilities, I think investing to swing trading is the best trading style for you guys. Mainly because trying to day trade when you have work, it doesn't go too well. Mainly because you have to be really focused and paying attention, and the optimal time to trade is either New York open, which is usually when schools or work is open, that's when they open, or during Asia, and that's like you're going to be up 2 or 3 o'clock in the morning. I'm not saying it can't be done, but it's going to be unnecessary stress, especially if you're brand new. Like you need to really focus more on how to identify the bigger move rather than trying to zone in and trying to find a bunch of small moves throughout the day or whatever. um, it's just going to be less stress on you and easier to learn, in my opinion. If I could go back, that's what I would have stuck with. All right, so in our strategy, what I'm looking for on the chart is four things. I'm looking for market structure, liquidity on the chart, identifying what price did and is currently doing, and then create a trade idea trading towards what price is doing, or set up a trap, as in wait for your price to hit the key level and either expect a reversal or a continuation pattern, which we're gonna get into that later in the course. I'm gonna put everything together, so don't worry guys. I'm gonna start from bare bones and do a whole thing. Market structure is either doing two things. It's either consolidating or it's trending. Consolidating is moving sideways, which right now in Bitcoin on the daily, we are consolidating sideways. And trending is this move down, it's trending down. So in trading, you got to really get used to these terms: bullish market, bearish market. Bullish market means we're going up, bearish means we're going down. Okay. To identify a bullish market is very simple. It's pretty much this right here. It's when price is making higher highs, higher highs, higher highs, while also making lower highs, lower highs, lower highs. That's an uptrend. Same thing going down, just in reverse. A downtrend is this. It's a market that's making lower highs, lower lows, lower lows. Simple. Reverse it. Okay, and then consolidation is this. As you can see, we're just going sideways. We're not really trending up or down, we're just going sideways. Maybe we break and then we continue down, or we reverse, continue up. Price is either doing those three things. So what we need to know is when if price is going to continue its trend or if it's going to reverse. So a reversal is obviously a break of structure, meaning the structure is bullish. So right now we are bearish, we're trending down. So you have two options: either you're gonna follow the trend, continue to follow the trend downwards, or you're gonna wait for this downtrend structure to break. So stop making lower lows and start to make higher highs, lower lows, higher highs. I mean, high. Stop making lower lows and start to make lower highs, higher highs, lower highs, higher highs. Okay. Um, so it should look in a very simple way. It should look something like this. This would be a break right here, because we're making higher highs, higher low. Even though we made a higher high, this new low broke this most recent higher low and made a lower low, and now we made a lower high, continued down, and broke this lower low. So now structure shifted. So I'm going to show you two ways to identify structure and how I use it. A lot of people online identify structure differently, and there's no right way. One thing I want to get you guys to understand: there's no right way to do any of this, because at the end of the day, everybody's looking at the same thing. You could look at nothing. Some people are good just having nothing on the screen. Just they are that much market experience, so they have nothing and they just understand how price works and price action. The only thing that drawings and identifying these things on price, the only thing it does, if you really think about it, is get you either to buy or sell. So I don't want you guys to think that my way is gospel, pretty much. It's the only way. Okay? So I'm gonna teach you two ways how I identify structure and how I put them together. Before we get deeper into market structure, we need to know how to identify highs and lows in the market. What is a high? Pretty simple. A high is a move up and a move down. That's your high. Low is pretty simple, move down and then move up. That's your low. How you identify this on the chart is it's a two candlestick pattern, okay? And this pattern has to be, for a lack of a better word, interracial. It can be two of the same color. It has to be a up and a down. It has to be two colors, okay? And you have to take, like, let's say we're looking for a high. It's a move up and a move down. The highest point of those two candles is your high. And then when you're looking for a low, a move down and a move up. That is the lowest point of those two candles is your low. Okay. So right here, this is not a low. Okay. This is your low because it's a two candlestick pattern. This is just down, down. This is just two down. You can't make a low going down, down. Okay. So it's a two candlestick pattern and they have to be interracial. So move down, move up. This is not your low because this is not the lowest point of the two candles. Okay, same thing with the up. This is a move up and a move down. Is this your high? No, it's not because it's not the highest point of those two candles. Keep it as simple as that. Now to identify a break of structure, what was it? To identify a break of structure was when the current trend shifts. Okay, so if we're going in an uptrend, means higher highs and higher lows. When it's a downtrend, means we're not making higher highs no more. We're making lower highs and lower lows. Okay, so how we see that on the chart is that once we break a high, and also quick to confirm a break, it has to be a full body close. Okay, so just for example, let's say this is the level that we're looking to confirm a break, to shift trend to the upside or downside, whatever it is. We need to see this, a full body. It cannot be like this. It cannot be a wick. It has to be a full body close, okay? It has to be a full body close. I'm going to hammer that home. It has to be a full body close because this is just a sweep of liquidity. We're going to get into that into the liquidity section, but this is just a sweep. A confirmed break is this, a full body close. Okay. So now we got that out the way. So for this example, I'm going to go here mainly because I'm not going to get into the technicals of how there was a break of structure to the upside. I guess you could say right here on the weekly, you could zoom into the lower time frames and see it sooner, and that's going to be part of the strategy later. But right here, boom, this was your most recent high, move up and a move down, where we're technically going on a downtrend. So to confirm that we're no more in a downtrend, we need this high to break. This is not a high. This is not a high. This is your high. The move up and the move down. And look, a full body close. Remember, these are not your highs. It's a two candlestick pattern. So this move up and move down was your high. Full body close. So once we got the full body close here, now what is your expectational order flow? We were in a downtrend, making lower lows and higher lows. You see, um, I mean, lower highs. See, lower high, lower high, lower high, lower low, lower low, lower low. If we break, if we're now shifting, that means the next low is not going to take this low because remember, it has to continue making lower lows. So if this is now a break, that means we are expecting a what? A higher low. So and that's what happened. We got a higher low and now shift the structure up. So once we get this break, the only thing you need to pay attention if you're now in an uptrend are lows, the most recent low. Don't once you're in an uptrend, you don't care about the highs no more. Now you care about the lows. This is your most recent low. Boom. Move up, move down. Now you pay attention to this low. This low doesn't matter. To confirm a break, it has to be the nearest low. Okay, so all you do is monitor the lows. So let's monitor this low until it breaks down again. Okay, so boom, I'll move up, move down, low. Okay, right here. This is, there's a new low here. Okay, would you say this is the new low, or would you say this is the new low? Wrong on both. Remember, it cannot be down down. It has to be interracial. A move down and move up. So technically, this is your low. But remember, even though price is going down this low, it's still not a break, because why? It's not a full body close. So you monitor the nearest low until you get a full body close to now put the idea of, okay, we are shifting structure. We're no more in an uptrend. We're going to start going down. So now I'm going to start looking for uh, lower lows and lower highs. Okay, move down and then move up. So now this is your new low. Technically did not break structure. We're still in an uptrend. We have not closed underneath this low. Move down right here. Is this your low? No, this is your low. Move down and move up. Remember, it cannot be down down. That is technically your low because it's a move down and a move up. Now we get our break. This is a anomaly. Sorry, my vocab. Because technically, later on, I'm going to go in more in depth into this. This is technically a big SFP. We didn't get the confirmation until this closed. So even though this candle went all the way the fuck down and went back up, on the weekly, it was not a break. Remember, it has to be a full candle. The next one was a full candle. So then it confirmed the break. But this doesn't happen too often. This was one of those days where it was just like a lot. I forgot what happened here. I think this is one of the liquidations that were like over 20 bill. I think it was like one of the biggest in crypto. It was a really bad day. Um, but to give you an example of that, maybe that's not a something that doesn't happen too often. Like let's go to last cycle. Right here, this was a break. Remember, we are monitoring the lows now because we broke here. We broke to the upside here. Boom. Now we monitor the lows. Boom. Boom. We didn't break structure here. Okay. We're now this low. We get a full candle close. So now what is your expectational order flow? Lower lows and lower highs. Lower lows, lower highs. Lower lows, lower highs. Lower lows, lower highs. Lower low, lower high. Lower low, lower high. And boom. And that's where we broke up again. There's no point of if we're in a downtrend, there's no point of monitoring the lows. Only monitor the highs. Okay. So with that being said, so since I showed you the example, that this is something that doesn't happen too often, but now that we break this low, what do we need to pay attention to now? The high. Boom. This is the nearest high. Went down, it broke again. So now we are technically in the uptrend now. What do we need to pay attention to now? The lows. Move down and then move up. This is a down and an up, even though it's very small. It is a white candle, so it is a low. Move down and move up. The lowest point of those two candles. Look, even though it went lower, people were probably like, "Oh my god, we're going to zero. Oh my god!" It did not close. So I would not have been like, I would have, if you were in longs, I would have not have closed my long. We moved up. It moved down and it moved up. Technically, right here, it was a break. And if you did go short here, you pretty much would have shorted the top. But even though it doesn't, and also you have to be very specific. Okay, you have to be very, what I mean by specific, you need to know what validates it and what invalidates it. You might have thought like, well, it was small, it wasn't like, it was like barely a close and we immediately went up, because remember, we're expecting, we don't see this, so we're just seeing this right here. Okay, this is why when you have specific cold hard definitions of what is a break and what is not, Because let's say we are right here. You're like, oh, but like it went, like we don't see any of that. But if you follow your definition and you're like, okay, even though we completely recovered and we're continuing to go higher, and we did make a new high, technically, we didn't make a new high. Look, we made a new high, we broke down, and we made another high again. But if you pay attention, since now we broke down, technically, this is the first break of structure to the downside. What do we need to do? We need to monitor the highs. Move up, move down, move up. Even though, and this is why I have two ways. If you go back in the beginning, I had two ways of identifying structure, okay? And this is an example of why I use these two. And I'll show you how I use them together, okay? Technically, a break of structure to the upside was right here. If you're going with the logic that I'm saying, like you need to pay attention to the nearest high. It did break, so now your expectational order flow is to the upside. But look what happened immediately after. We went straight to the lows, to these lows, and we didn't break until right here. Obviously, we're in the higher time frames. When you zoom in closer on the daily, you get these sooner, because obviously if you're on the daily, the first break of structure was up here. Whoa, do you see how better that entry is than down here? So going back, this is why I say on the higher time frames, look for your key levels, hit your key level, and then you zoom in onto the daily. Oh, look, we hit our high. Let's pay attention to what's going on here. Oh, we're waiting for confirmation. There's going to be something that I'm going to get into. Right now, we're identifying what is a break, what is not, how to identify structure, okay? So the way I showed you right now to identify break of structure, that is one way how I identify it. If you want to be very, I use that method when I want to do sniper entries. Um, if I want a double confirmation that this is a downtrend, I look at structure like this, okay? So that way I just showed you, when you monitor the lows, you zoom in, that is the technical way. And if you zoom into the time frames, you could get earlier entry, okay? Now I'm gonna show you the other way, how I mark structure and how I use these two ways of looking at structure together, okay? So now this is now how I do some of my structure analysis. I like to zoom out and I like to just use my eyes. What am I like? What does it look like? I still use the same concepts of a move up and a move down, but I'm a little bit more lenient with it. I use the lowest point of the whole move now. I don't just look at the two candles, I look at the whole move, okay? Sorry. So now this is the current structure. Move up. This is why we're a bull market. And this is why when we were here, at the time, I wasn't too bearish because it was just a pullback, okay? Remember, if we're in a uptrend, yeah, sorry, my mic died, so I'm redoing that part. So this is how I mark my second version of structure, okay? So this is how I figure out what the higher time frames are doing, and this is good for the swing trading, the type of strategy I'm showing you. When you're on the daily, this is a lot of noise. You know, like this is a lot of movement right here. Breaker starts to the downside, scary. Oh my god, like people got really chopped out of this. This is a lot of movement. When I want to kind of limit the noise, structure is a really good way of doing that. So when you zoom out to the higher time frames, it helps you limit the noise. So a lot of times, if you're just like there's a saying in the space saying that um always zoom out. When in doubt, zoom out. Okay. Before, I was on the daily, but I started down here. When you go on the monthly time frame, it's a clear uptrend. currently, as of right now, we are getting down here, but we are making higher highs, higher lows. And if you really want to be surgical with it, if you use the method that I just taught you right now about how to identify a break of structure using the full candle close and being very um, strict with it, and this whole move down, remember, it was really noisy, all that chop, oh, it looked really scary. If you just stuck to the monthly time frame, you would have been bullish this whole time because move down, move up. Remember, we are in an uptrend, so since we're already in an uptrend, you only pay attention to the nearest low to see if we're not in an uptrend no more. Move down, move up, the lowest point right here. Move down, move up, lowest point down here. Move down, move up, lowest point down here. We did not get a single candle break close on the monthly. So if you were investing in that time frame or swing trading, it would have helped you keep calm while everybody was freaking out. So now how I like to do this second structure is I zoom out to the monthly or to the weekly, and I do use the the low that I mark out is a two candlestick pattern, but I take the whole move now. So now I take this whole up move, which is up here, and this whole down move, even though there's a bunch of up down here, the whole down move is down here. That's the lowest point. So that's why I mark it like that. Highest point, lowest point, highest point, lowest point, highest point. And when do I confirm in this way of marking structure a new high? Okay, because right here was the high, but I didn't have two highs here. No, I just, for me to confirm a new high, it has to break the most recent high. Okay. What when I'm looking at you could do it this way. So this is actually a really good example. Okay. Exactly what I'm trying to show you right now. Let me just do it right here. So if you're doing this macro trend, this is your macro high. So now this is the high that needs to break. But I keep this on the chart and now I monitor. So this is why I do the two versions. Okay. The reason why I do the two versions is because if I break structure here to the upside, sorry, actually, no, we broke, move up, and then move down. So this is the break. We broke here to the upside to help me not be like, oh, we broke, so now we're going to go fucking zip up. I have this macro high here. I know that we are not going to zip up unless we get above here, period. And it's the most recent macro high. So any highs that get created here, they're just areas of interest, okay? So even though I broke this high, if I was trading here, I would have just aimed for this high or this high. But I'm not aiming to see that we're going to break higher. If we do, great. I hold it, we go higher, but I'm still expecting down because internally we are going down, okay? So I hope you kind of see where I'm getting at, where like now these macro highs and lows become targets because now if I zoom into the daily here, if this is a macro high and on the daily we're obviously in the downtrend, if we break structure here now, I could now target these highs, boom, 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 as targets to take profit. But we're down here, move up, move down. This is the first break. This was the last break of structure before the rally up to new all-time highs. But it's a clear target now. I could target these highs, these highs, these highs. Okay. And if we get up here and we take it and we continue, then perfect, great. But it helps me keep clear targets on the chart and a clear level of where I need to get over. Okay. And the reason why this is actually a really good way to look at structure to do these two versions of zooming out and getting the whole move and then zooming in. And if we're moving down and if we break structure to the upside, just know that this is not your long shot. We first need to get over the most recent highest point, okay? Because that would have saved you here. That logic would have saved you here. If you remember earlier when I was talking about here, how we broke structure here. Where is my tool? We broke structure here, but we didn't go higher. We immediately dumped down. But if you follow that logic of taking the highest move here on the weekly, we are on the weekly time frame. This is boom, 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 boom. Actually, let me make it easier for you. Like easier to see. Let me get this shit out. Let me redo this for you. Where is my replay tool? Uh, Perfect. Okay, now let me redo it. Okay. If you were marking it how I was doing it right now, with just taking the highest point and then the lowest point after making a new high, you don't start looking for new lows until we take this high. I don't know if I said that. So this is whatever lows get created before taking this high is you keep moving it down. Okay, so this way of marking structure, it's shifting. You need to wait till candles close to really get confirmation. Okay, that is the real low. Okay, um, in this way. So this is your swing high. Now this is your swing low, meaning your highest low. I mean the highest point and then the lowest point currently close to you. But we get this break here. Now, with my version of this structure, same validation. It needs to be a full candle close. It cannot be a wick. Use the same validation. This candle made everybody believe that, oh, we're going to 150. A lot of people got really bullish. But if you just waited and if you follow the same logic and use these two structure methods together, you would have saw we never got a full close. And since we never got a full close, you would have I would have told you how you would have shorted that, but this is actually a SFP, swing failure pattern. I don't want to get too ahead, but remember, to validate an uptrend, we need a full candle close. We didn't get a full candle close, so that means we were not going higher. We got a wick, so we're not ready to go higher, okay? But that's how when you use these two structures to when you use them together, it gives you like an extra validation, okay? So the way I showed you in the first place with being very specific with the two candlestick patterns, that is when you already have your macro figured out. Because look, you have your macro high, your macro low. So now what is the nearest? Let's say you're right here. This let's say now you're right here after you made this new low. And the same logic, do you know how I said to confirm a new high we need to break the previous high? Same thing with the low. To make a new low, boom, we broke this low, so now this is the new low. But we broke the new low, now this is the new low. So technically you would have been keep on moving this down. But to confirm that this is actually the real low, we need to get confirmed break to the upside. So move up, move down, Now this is an okay. Now is a perfect time to actually no. I'm wrong. I'm gonna get into that later. That's the highest point. You see, even I make mistakes, and that's why I need to double check. And do you see how I mean, like in the beginning, if you a lot of times people just mark it wrong. They have this right concepts, they have the right ideas, the right strategy, but they're just marking it wrong, and they're getting caught up, or they're taking a bad trade. But in reality, if you just marked it correctly, you would have saved yourself. Like right there, just right there, how I marked it like that. I marked it right here, and I was like, oh look, a break. But in reality, no, because it's the highest point of those two candles if we're looking for a break to the upside. A move up and a move down. This is the highest point. You see, it wicked it. So we're going lower. But what confirmed this low to be a real low is we got to break a structure to the upside. Okay. So after this low, it touched it, a move down and a move up, the lowest 2 points, a move up, uh, sorry, a move up and a move down. This was the high that broke. You see, it broke the high. So now you could say, this is my low. This is my higher time frame. The higher, when you take the whole move structure, that's that whole move structure's low. And since we got the breakup structure, now you could start looking to go long, meaning to go look for the upside, because internally there's the macro and then there's the structure inside. So now this is the macro trend. This is on the higher time frame. We are still on the uptrend, but inside this leg, inside this move down, we broke structure and we're looking to go higher. And how you trade this, I'm gonna get into that later, but that is the idea. So now when you break structure internally inside of the macro trend, you could start targeting this high, that high. And if you did, if you went long there, that would have been a good trade. It would have eventually gone there. What you just saw right there is a perfect example of liquidity. That's going to be the next part of this course, but that is why I use those two structures. I hope that makes a lot of sense. If it's confusing, don't worry. If you guys continue to follow me, I will make in-depth videos about everything I'm talking about right now and more. Right now, I'm just getting a bare basic course, and I'm just trying to get this out just so I can have something out there for you guys, okay? Um, but even, let's say right here, down, we didn't break above this macro high. We didn't close above, we broke down. So now what can we target? The macro low. And look what happened. If you went short here, we went straight for that low. And the reason why that happens is, we're going to get into that later, it's liquidity. But I hope it's I hope you understand what I mean on structure and how to identify it. Okay, so in conclusion, market's doing two things. It's either consolidating, going sideways, or it's trending, period. To confirm a break, we need a full candle close on the level that we're looking at, okay? A uptrend is higher highs and higher lows. Downtrend is lower lows and lower highs, okay? And yeah, I'll go show examples later on, top down analysis, all the way through. All right, so next thing, now that we got structure down, how to identify ranging markets, trending markets, all that cool stuff, whatever. So next thing on the list is to how to identify liquidity. The reason why identifying liquidity is important, because that is one of my key points on how I do my analysis and how I do my trade ideas, okay? The reason why is because the market does three things. Even though I said it does two things, but price itself, like it's doing these three things. Price moves in consolidation or trending. But in that move, it is doing these three things, okay? Hope that makes sense. So it's either generating liquidity, which is usually consolidation. Right here, it's generating liquidity. Attacking liquidity is this move down. And rebalancing an imbalance. So it either generates, attacks liquidity, or rebalances an imbalance. Okay. A rebalancing of imbalance is pretty much this move right here. It's a pullback to the continuation lower, pullback to a continuation lower. It usually looks like this. This pullback is your rebalance because we're already in the uptrend. We are rebalancing because we had an explosive move up. The market participants didn't get enough orders filled, so they're gonna rebalance it because there was an aggressive move up, rebalance it, and they really mean business. That's why it's a rebalance. The reason why it's in a rebalance because the people that profited all this move and they're anticipating prices to go higher, they're gonna buy on the next pullback, buying the dip. So that means if there's enough participants pushing price upward, that means this move down to the continuation was a rebalance, okay? And then this move is attacking liquidity. This is generating liquidity. It's going sideways. We don't know which direction it's going to go yet because it's generating the liquidity so it can move to the direction. And liquidity is in every single highs and lows. So liquidity here, here, here. Every single high, there's liquidity. There's liquidity everywhere. Okay, you could you could use tools like heat maps and other various things, order book, stuff like that. But I'm not saying they're bad options, but I want to keep it simple. If you could analyze and identify these things without those extra tools, the better. Zoom out to the monthly. Like I said, where is liquidity? Above highs and lows. So if you want, you could use the first way how I showed you the structure to know where liquidity is at. Where is the nearest low? Oh, right here. So that means this is macro draw on liquidity. So on this, because this is the monthly, that means price wants to go here and take this liquidity. And if you look at it visually, oh yeah, we came, we attacked this liquidity. Remember, it's either attacking liquidity, generating, or rebalancing. So we attacked, consolidated, generated, and now we're attacking liquidity to the downside. But now remember, on the macro, this is a giant move up. We're still in an uptrend on the macro. So right now we are attacking and generating liquidity to the downside, but on the macro, we're actually rebalancing. So now this is why this 74K level is very, very important. Because remember what I said, to confirm this was a rebalance, we need to make a lower high. So if we stay above this and we start continuing higher and start taking this liquidity up here and start closing above here, then this was a confirmed rebalance. And this next break, if this next rally up, we break higher, I think this is going to be enough power to move it up to at least like 140. I'm not going to be too optimistic and do these moonshots that people say, but as you can see, macro, we're in a macro uptrend. That the bear market does not end until we close underneath here. So now technically we attack liquidity to the upside, generated, and now we're attacking to the downside. So even though we're going down on the macro sense, when you zoom out, we are rebalancing. So now to confirm this is a confirmed rebalance, we need to stay above this. Okay. And if this is a rebalance, that means we're gonna hit new all-time highs, which if you're asking me, I don't think we are just yet. Um, but yeah, so there's liquidity right there. Go to the weekly. Where is liquidity? Where is your nearest high? Okay, move up and move down. This is your nearest high. Boom, liquidity right there. Previous liquidity. Move up, move down. Liquidity right there. And just keep these lines on the chart because these are points of interest. Because the reason why there's liquidity up there is people put their stops out there. If you know, if you're trading, I don't know if you guys understand this, but I could go deeper in depth on how this works. But when you're trading, and let's say I want to go short here, almost everybody's putting their stop loss here. So meaning if price comes here, they're getting out the trade. But when price gets out the trade, the reason why you could place a trade whenever you want is because there's market makers. And when you sell, the market maker has to buy your position. So when you have to buy, the market maker is selling. So when you get stopped out, the market maker that you're selling, but the market maker's buying. That's why sometimes it just explodes up, because if a lot of people are shorting, meaning if they hit this line, their position is now going to be a buy. That's why it shoots up, because if there's a lot of people shorting here, meaning they're shooting for the way down, but price hits here and continues higher, it explodes up. That's why there's like huge moves like this, because everybody was bearish as hell right here. Everybody was like, oh, we're going 0 0 0. So down here people were shorting the fuck out of this. That's why on the next break it was an explosive move up. One thing that I want to show is an SFP. An SFP, the definition is called a swing failure pattern. Okay, it's this. You're gonna see this a lot. This is one of the confluences that I use to take a lot of my trades. This is an SFP. Do you know how I said you don't break structure unless it's a full candle close? But if we get something like this and we don't close above, it's an SFP, meaning the swing structure is to go higher, right? But since we didn't go higher and we went lower, that means the the swing structure failed. That's why it's a swing failure pattern. So that means this going higher move failed and it went lower. So when you see SFPs, they're really good trades because there's a very tight invalidation, and that's pretty much it. It's a clear invalidation. Because what an SFP is telling you is a lot of times when market makers are about to bring price up, market makers move price down before they bring it up. And before they bring it down, they move price up and then they bring it down, because the market makers are going to get the best fill. They're always going to sell at the tops and they're always going to buy at the bottoms. You're not going to do that. Okay. So if we go with that logic that market makers always get the best fill, then we know when we get a wick that that means they got the last move down, they got all that liquidity, made people believe that we're going lower, went short, to shoot it back up. Like right here, this was a clear SFP. If we were right here, ignore all this price action. Remember when I was here, this was the low. This was the new low. When this new low was created, what happened? We didn't close below, so it wasn't a break of structure to the downside. But what is it? It's an SFP. It was a wick. So now when you had this weekly close, if you want, you could have opened a trade here and invalidation at this low. And the reason why, when you get an SFP, this is why I love the S&P a lot, because that means with that logic, if this is the last buy to the last sell to buy to go higher, that means that low is a protected low. It would invalidate if we close underneath a full candle close. A wick is fine. If we get a full candle close underneath, then it invalidates it. So now it gives you a clear invalidation, and now just target previous draws of liquidity. This high, this high. You see now where it's coming together, where now you mark this high as liquidity, this high as liquidity. You would have took that long. You probably would have took profit here because that's liquidity, profit here, and it hits it. Price goes towards liquidity, period. That's why liquidity is very important, and know where to identify it, because it's clear targets. You're not over here like, let me do a three to I always do a 1 to 3 risk to reward, whatever, yada yada yada. I'm not saying that's a bad way, but this way gives you clear points on the chart where you need to make a decision. And that's the main thing I want to hit home to you guys. This is not no, oh, well, it's systematic, but I want to make it clear definitions. Okay. Like clear invalidations, clear everything. So if you get an SFP, if you want to trade the SFP logic, obviously not every single SFP works. Nothing's 100%. If you think you're going to get into trading and you're going to win 100% of your trades, or you're going to get to a point where you're going to win 100%, that doesn't happen. Even the best traders in the world lose. It's part of the game. You will lose. So SFPs don't always work, but that's why I love them, because there's clear validation. They don't work once you close underneath here. You close underneath here, close the trade. Okay, boom, it didn't work. But when they do work, it's always a massive move. It's always a massive, huge move where you could recover a lot of your losses. And that's where risk management comes to play, and how you could capitalize on these moves. Okay. So now that we know how to identify liquidity, which is you go on the higher time frames, look for your highs and lows. Okay. Use the two candlestick patterns, the most recent highs and lows that hasn't been touched yet. Those are your draws on liquidity. The higher the time frame, the more weight you put it. Okay. If you use like a 4 hour high, it's not going to be as strong as a weekly high or a monthly high. Okay. um so keep that in mind. The higher the time frame, the stronger the level. Okay. So price does three things. I'm gonna do a quick recap. It's doing three things. It's either generating, attacking, or rebalancing the imbalance. Okay. Before we start getting into the confluences, pretty much key levels, the tools, your confirmation and your continuations, because I break down my entry model in three ways. My confluences, which is pretty much your key levels, areas of interest. Confirmation, once we get to that areas of interest, what am I looking for to press buy? And continuation, what am I looking for after press buy? Or if I want extra confirmation, what am I looking for after I see my idea play out, to confirm it even more? That's going to go still in that same direction. Okay. So before we get to that area, I want to talk about three patterns that you need to train your eyes to see. Okay. In a trending market, you're going to see this a lot. This is called a continuation pattern. Oh, we move up. If we're in a bull market, we made a new high, we pulled back. If we're going to continue in the bull market, that means when you're buying here, you're expecting this high to take. And if we are in a bull market, boom, continuation. And it just continues. And this is how you trade the trend. If you're in a bull market, you want to buy on the dips and sell on the rallies. You don't want to buy here. You do not want to buy here. If price is leaving, do not buy. Wait for the pullback. It always happens, guys. I know it might be tempted to be like, oh, we're moving up. Who cares? Wait for the pullback. Patience pays. Okay. Um, Retrace. Mark out the next high. If this is going to continue, you wait for the pullback and you see your confirmations here, whatever, the break of structure to the upside, you enter, and now you're expecting this to go. And if it can, and now you're expecting continuation. Simple. Same thing to the downside. Continuation to the downside. Same thing, just inverse. Okay. We're in a downtrend. We make a new low. If we're in a downtrend, what are we making now? Lower lows. So now we make a lower high. If this is gonna be a rebalance and continue lower, then that means we're gonna take this low out again. Continuation pattern. Okay. You're gonna see that pattern a lot when we're trending. When we are in a trending market, this is the pattern that you're gonna see a lot, and you need to train your eyes to see it. Um, it's easier when you go on the lower time frames. See, made a low. That's the low that we need to get down to make the continuation pattern confirm. We make a high, we break the low, we make a new low, new high. What is the new low after we had the continuation to the downside? This is the new low. So that means on the next rebalance, on the next rally, we are expecting on the next move down to take this low. Continuation. Okay. Let me show you for the uptrend. Okay. Yeah. Boom, break this high down. What's the new high? It was going to continue. That's the new high. Boom. This is the new high. If we're continuing bullish order flow, bullish trend, then that means the high is always going to take. Okay. So when we're in a trending market, that's the pattern that you're going to see. Now, here's two that I need you guys to train your eyes. Okay. To identify a topping structure, meaning when to kind of know, like, okay, this is looking bearish, or yeah, when it's looking bearish, where price is likely to reverse, is called M's. They look like M's. And the opposite, when price is about to rally, W's. When you're at the top of a market, you're going to see an M. When you're at the bottom and we're not going any lower, you're going to see a W. Okay. And this is, you're going to have to train your eyes. You're not going to get good until you do it a million times. You're going to have to go back in time and just identify, like, go to like the 4 hour time frame daily and mark out W's, M's 100 times until you just see it. Like, for example, oh, W formation, shift out, M down. Right here was an M into a W. But now, do you see what I'm saying? It goes to an M, into a W, into an M. You're gonna see these three patterns happen all the time. Your continuation in a trending market. When you're at the top, you're gonna see M's. When you're at the bottom, you're gonna see W's. Okay. What do you see here, bro? Like, M down. This is a really ugly W, but not all M's and W's are gonna look pretty. They're not all gonna look good, and this is why you need practice. And to confirm an M or a W, it just needs to look. Let me look one that's crisp and clear, very crisp and clear. Let me go on. It's easier to see. It happens more on the lower time frames, a lot more. Uh, delete all this bullshit. All right. Okay. You see, here's a clear W, clear as day. So if a W is technically generating liquidity, because after a W is created, technically it's attacking liquidity. So since it's attacking liquidity and now it's trending the opposite way, a W now goes into a continuation pattern. Okay, so this is how this looks. So same thing with the M. It goes into an M, break, up, continuation down. W, down, W, break up, down, continuation up. Boom, boom, boom. We broke out of this high, pull back, continuation. Now, pull back, continuation. And this is what I mean, is not always gonna look picture perfect. It's gonna look ugly. It's not always, you're not always gonna get picture perfect setups like that, okay? Now let's show you a version of an M. Oh, right here. M break. And what confirms the M break is that peak bottom right there. Goes lower. Retest, down. So when you're at the highs of the market, pretty much what I'm trying to get out of this, well, what I'm trying to hammer home, when you're at bottoms, like right here, we are at the bottom of Bitcoin. What do you see here? A little mini W. you could have got into a trade here. You would have saw this W formation that, like, okay, if we break this high, that means it would have been a W. You could have probably entered a trade here or waited for a pullback and got in, and you would have received some profit. It's up to you when to take profit. Not every trade is going to be a home run, okay? Always take profit. But you need to really train your eyes. Right here, little mini M right here. See that? Down, break, retest, continuation. You see? What do you see in these two highs? Continuation. M, break, continuation. M, break, continuation. So in trending markets, you're going to see this pattern. When you're at the bottom, when there's going to be a low, you're going to see this pattern, W, break. And when you're at highs, you're going to see this pattern, M, break, retest, continuation, okay? Do some homework. Go into the low time frames because it happens a lot more. And identify W's. And you know it's a confirmed W if it continues higher. Not, remember, everything that I'm telling you is not gospel. It's not going to happen. Not SFP works. Not all breakup structures work. There's a lot of breakup structures where it gets confirmed and it just dumps down, like I showed you before with Bitcoin when we were at the highs in the weekly. Technically, we had a breakup structure, but what happened? It went straight rip down. But this is why what I'm going to teach you next is going to teach you how to filter out all that noise and give more context to why you're doing it and maybe help you see something that you're not seeing, right? But that's the three patterns that happens all the time in all markets. It doesn't have to be crypto. It could be forex, stock market. It happens. W's actually are really good for Nasdaq. If you're a Nasdaq trader or want to start trading Nasdaq, W's happen all the time on Nasdaq, and that's probably the best way to trade Nasdaq in my opinion. Sorry, sorry about that. But yeah, so continuation pattern, W's at the bottom, M formations at the top. Okay. Once you break out of the M's or W's, start looking for the continuation pattern. Okay. When we're consolidating and we break out of consolidation, you're looking for continuation. Okay. Price does three things: rebalances, generates, or attacks liquidity. Okay. And liquidity is important because why? That's the way the market moves. It can't move if there's no money. Period. Let's just keep it simple. Does not make it complicated. And before the market's going to move up, what is it going to do? It moves down first. That's why you see SFPs, because before it's ready to move up, it SFPs the lows and it goes higher. And if you go back in time and you look at SFPs, you will notice that a lot of times they're W's. A W SFP right here. This is a low. We wick that low and we continue higher. Remember, the market moves down before it wants to go up. Before it wants to go down, it goes up before it goes down. But what else do you see here? It's a W formation. Look at that. So study this pattern, go back, find a bunch of W's and M's, and then find the continuation pattern after. Identify what market's doing. Is it generating? Is it attacking? Or is it rebalancing? Okay. All right, I know you guys are wondering probably why I'm in a different scenery. When I was doing the first part of the video, it was the day before Christmas Eve, so I'm just gonna finish it up here. I'm at a local coffee shop, so I'm gonna be a little quiet, but I'm still trying to get this done. Now we're at Confluence. A lot of people have different definition of what that means. For me, it just means key levels. What are the areas that you're looking to take a trade? Um, Confluences to me is not like this is what's making me press buy. Okay, that's confirmation and then continuation. But in this one, we're gonna look for key levels. What are key levels to me? What are zones of interest, pretty much. I'll be going over three confluences. I don't want to bombard you guys with a bunch of different things to look at. I want to keep it very short and sweet. So this is a good fundamental basis, in my opinion, because these kind of let you focus more on value-based analysis rather than moving averages or a bunch of other indicators that um, they're not bad, but I think at the end of the day, if you are trading crypto, forex, stock market, it's all value based. The reason why you're pressing buy is because you think it's going to go up in the future. It's all value based psychology. So with that being said, the three things we're going to go over is structure highs and lows, order blocks and imbalances, and volume profiles. Okay, so for structure highs and lows, obviously, if you've been paying attention, a bunch of liquidity up there, and um, market structure is king. We can't continue on a bullish market structure if we don't take the high. So highs and lows are very important. I will show you how to mark proper ones. Order blocks is the last move before the market shifted to the opposite direction. And the reason why these order blocks are important because if these big money investors or market makers are trying to fill much of their orders, um, sometimes they won't be able to fill their full position. So a lot of times, whenever price moves aggressively out of the zone, it's going to retouch the zone so market maker can fill the rest of their orders. Okay. And the last thing is volume profile. This is mainly because the way I'll be teaching you guys is using it in the range that you're trading, because this is going to help you not buy at the very peak or sell at the very low. It's going to show you where the value area high, low, and the point of control. I will go over how to read that and the logic based by it, but see as the volume profile as areas to either sell or buy in the range that you're currently trading. Okay. And the points of control is where most of the contracts were being traded. And the reason why that's important is if there's a specific zone where there's a lot of contracts being transacted, then that's a very big zone of interest, which is more likely that price is going to want to keep on. It's like a magnet. It's going to keep wanting to go back there before deciding to go to continue up or continue lower. Before you start marking out any other key zones or points of interest, you should, me personally, I mark out first the structures, highs and lows, and then I look for the volume profiles, order blocks, and stuff inside. Mainly because me personally, I don't like to have a bunch of stuff on my screen. I like to keep it pretty nice and clean. Like, there's no point for me to look for key zones or points of interest really like down here. There's no point for me to look anywhere down here unless we start to get closer to that area. There's no point, no point to look at up here in this little range, key points or whatever, if we're all the way down here. We're not close to it. So, how that helps me keep it very simple and very clean is like this. So, let's go back, mark out our structure. Remember, if you remember when I'm on my structure video, I'm just gonna do it for Bitcoin how it is currently right now. If you are following me right now, then you could do the same key levels at this very moment, which is December 27th, 2025. So this is our structure. Remember, zoom out. Let's go on the weekly. Let's go on the monthly. Let's see how the monthly looks. Okay. Let's mark out our macro swing structure. Boom. Okay. We're obviously in a bull market. This is a very significant low. We're on the monthly, and remember, the higher time frames, the more weight these levels have. So then I would mark this low as my very significant low. This low is very important. You don't have to do the colors that I do. I usually mark them out, and if you don't know how, you could double click Oh, sorry. You could double click and it gives you the options too, or you could click and you get this little bar. On your trading view is going to be in different places. It's not going to be in the same place. But I usually like to mark them just so I know what I'm looking at on the screen. You don't have to mark them at the same terms that I do. This is just how I do it. You could say this is just danger low, significant low, just whatever the fuck. I like to do when I'm looking, zooming out on the monthly and weekly, I tend to mark those highs and lows as macro. If I do it on the daily or on the weekly, I mark those levels as swing. And then if I do it on anything lower, it's like local highs and lows. Okay. The reason why I do it like that is just my preference. It helps me kind of identify like the weight, because if I see, oh, this is a macro level, that means this is a high zone of interest, like a zone where it's going to be a big reaction. Either we're going to continue down lower or this is going to be the reversal point. So when I mark it out like that, as in macro swing, this it gives I can already see without having to zoom out and see where this high came from or this low came from. I can already see like, oh, this is the level of importance this level is. That makes sense. So I could do like macro, put it to the right, change the font a little bigger so I know, maybe bold it out. Let's say this is the macro low. Okay. That's a little bit too big for me. I like it a little bit smaller. And then you could say up here is the macro high, which it is. Macro high. You really don't need this no more because you already know this is the macro leg. I zoom out on the weekly. And I don't fill these out because we already took these lows. But if we were right here, like let me just show you. If we were right here, then I will zoom in and mark this structure. So obviously this was the low, boom, 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 right? Then these would be swing lows that I would pay attention to as targets or maybe areas of interest, maybe for a trade. And if we press the play, you can see it does tap it. This could have been a trade because it hasn't been tapped. This could be a decent long. Eventually it gets to the zones. Price goes where liquidity is at, and this is why these levels, if you remember on my previous segments, liquidity is the most important thing because the price can't move if there's no money behind it, period. And whenever there's liquidity in either side, either two things are happening: people are buying or selling. And also, there can't be a buyer without a seller, there can't be a seller without a buyer. Okay. And if you're a market maker and I'm going against you all the time, then if I want to build up buys here to maybe sell up here, I want to drop price as much as possible. Okay, everybody's scared. Or if you're in the trade, if you have a trade down here, this is your trade, your stop losses are down here. That's most likely, if you got in here, that's probably how their trade looks. And if price hits down there and they have to get out, their sell turns into a buy for the market maker. So actually, when you get stopped out, the market maker's buying that stop out. And then on the way up, same thing. If the short sellers are right here, let's just same thing up here. Oh, wrong tool. Let's say we're back here. This didn't happen yet. People would have, just so it'd be easier to look, just so it'd be easier to see. Same thing right here. So let's say this hasn't. I'm gonna keep that on. I'm just gonna hide it. Same thing right here. If we were right here and you got into a short trade, most people are gonna have their trade's gonna look like that. Eventually, when price, and this is why SFPs and liquidity sweeps, why you see like prices quickly go up a high and completely go down. Because if you're a market maker, you want to get as many sell orders to go down. The market maker is going to get the best fill always. So that's why, and this gets a wick like that gets people to believe, oh, we're going higher. Because when we were here, when we were here, everybody, even though it reversed immediately, mind you, this is on the weekly time frame. We're on a higher time frame. When you zoom in, it was like people were going insane. It looks crazier, but it gets people to believe we're going higher. So now it gets people to sell their positions and buy up here. But if the market makers building their shorts, then they're getting everybody to believe we're going higher. Their buy is going to be the market makers buy down here, because if you're getting along here, you're gonna sell out of here because you're like, I can't take it no more, it's too much of a loss. Your sell is going to be his buy now. Okay. Okay, hopefully that makes sense. So let's go back, marking out these levels. Let's take this out the way. Boom. Okay, so we will zoom in. Obviously, significant lows already got swept, so you don't have to mark those things. Whenever they get swept and clearly broke through, I take them out the screen. I don't like to. Some people keep them on because there is possibility it could reject off of there and down, but that's why I do order blocks and volume profiles, because they could kind of already tell you that that's an area to sell if they are going to sell. So okay, so I zoom in. There's no significant highs or lows because this is a major low. So since this is the nearest macro low, now if zoom in, let's go on the daily. Let's mark structure from all the way up here, because there's no lows to really take, because even these lows got taken. I guess you could say this one, but we're not going to mark that right now. Usually once I get this, I start from the top, because now we're looking for the resistance going higher, right? Boom, 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 boom. So now these highs become the reason why you don't care about these. You want the absolute high and the absolute low. These highs don't matter because this high swept it. So who cares about what happened here? So then you will mark this one, and whenever you see like little bumps like this, that's gonna be an imbalance, and I'm gonna get into that. Boom, and then I will mark these as like um, oops, swing high, swing high. Take off the boldness so we know it's not like, oh, really pay attention. Since this one's very close, I don't technically do it as swing, because not only is this very close, but also we are consolidating. So this high would be your local, and I get it a skinnier one. Let me make these more bold. I'll make this one very bold, and then this would be your local high. I'm gonna put the letters smaller so I can see the significance of that, and then your local low. Alright, I'm gonna put these in a folder. I'm gonna say levels. I could take that out now. Boom. Okay. So now we get the first part done. We got our local swings and macro highs down. Okay. And another thing too, I know you guys have been hearing me talk about I trade the range. One thing that this helps me do is see the ranges within ranges. So now you can see this is a range. You can see this is a huge range. You can see this is the current range. So if you want to zone in and like clean this up, it's easier to clean up. Like I have range tools, could show you how to. There's not gonna be a video showing you how to, you know, do the trading view, like making your analysis easier, you guys could do that on your own time. But like, oh, I already know this is range low, range high. I'll just hide this. Boom, boom. And instead of having those two levels, I could just do it like this. Now I have the range high, range low, and the 50% range. And I would really recommend to find the recurrent range. Like if you're gonna be trying to trade this range, then I would recommend to, how do I say this? I recommend for you to make your range, okay, and then always get the 50% level. And the reason why the 50% level I like it is because one of my rules that I do now is that um, I don't buy, meaning I don't go long in premium and I don't short in discount. And if I'm gonna long in premium or short in discount, now if I am in those zones, I go lighter size. So what I mean is this. So if this is the zone that we're trading, right? And to better visualize it, you could get this tool. You don't have to do this, but this is better visualization of what I'm talking about. Okay. So if this is the fair value of price and I want to get the best buy order, and this is going to take a lot. Damn, this shit's falling my bed. This takes a lot of patience, and when you're a beginner, it's really hard to have patience. But one of my rules is very simple. If we are up here, if we are up here in this area, and if I want to go long, meaning I want price to go higher to make a profit, then I go lighter size, because going based off value, it's very expensive at the current price, right? And but if I'm up here and if I want to sell, make profit lower, then I'm finding a sell trade at a more probable area. You know what I mean? Because at the end of the day, you are gambling. You don't know what's going to happen. Nobody knows what's going to happen. Anybody who tells you that they know the future or they could predict it, they're lying. So the best thing you could do is find probabilities in the market that you see and put as many of those probabilities in your favor so you could get a higher probable trade, a trade that's more likely to be a profit. And then that's when your risk management comes in play. That helps you keep those profits. Your risk management is there to preserve your capital. It's really easy to lose it, and it's really hard to gain money in this game. This is the easiest and hardest way to make money. So I'll always recommend, after you mark your highs and lows, find the current range you want to trade. Like trading this range is mostly for like swing day trading. For you guys that are, I will assume you guys have a busy schedule. You guys don't have all day to be on the charts. I would recommend to like zoom out and like trade this range instead. Um, I will recommend you guys trade the macro or the swing levels. So let's take this out. Remember the macro. Oops, sorry. Macro low to macro high. So if I were you guys that has a full-time schedule, responsibilities, and other stuff like that, I'll recommend to just mark this out, turn off your levels, and now this is your macro range, meaning now when you're down to 50%, anything under $100 is technically a discount. And now you can have these little middle points where, oh, if I'm down this middle point, if price gets lower than 87,000, then I'm going higher on the buy. And later on, I'm gonna show you how to enter with this logic, a decent entry model that I think will help you guys. Um, Mind you, doing it this way, you're gonna be holding these positions for maybe weeks to months, okay? And always have an invalidation. Like if you a very trading does not have to be difficult whatsoever. If you want right now, and this could be a successful strategy. Let's say you have, I don't know, $1,000. Oh, I'm right here at the 50% of the discount. So technically, this is a discount. Now we're 50%, and this is 100% discount. Um, That's how I see it. So you could get your $1,000. Let's say I want to risk my whole thousand, right? I'm gonna go boom right here. Stop loss is down here. If price gets down here, I'm getting out. And I'm gonna target whenever we hit this 50%, I'm gonna start taking profit. As soon as I hit the 50, I'm gonna take 20% off and then put my stop to break even and let the rest ride. And you could keep it like that simple. It could be that simple and you could become profitable. But the problem is that human emotion. And that's something that we're going to get into and not too deep in this video. But what really fucks up the simplicity of this is your emotion and your emotion of wanting to make money, your emotion of not wanting to lose, uncertainty, just your basic human emotion that everybody has. But trading could be very simple like this. And you don't need no crazy indicators. You could just find your premium and your discount. You're like, oh, okay, I'm in discount. The probabilities is that if we are going to continue with the structure, remember on the macro, on the higher time frame, we are technically on an uptrend. To invalidate this uptrend, what do we need to happen? We need a close underneath this. So as long as there's no closer underneath here, we're good. So you could buy here and wait if we close underneath. And if we do, get out and now target this low instead of holding all the way down. Or you could hold and add more, but we're not gonna complicate it right now. But it could be very that simple like that. It just really depends on your time, when are you trying to see a profit, your risk tolerance, your account size, because and because this is why I enjoy doing this, because there's a way to do this for everybody. If you're a type of person that likes to be in and out, like right here, we are on the 4 hour, we zoomed in, technically this is the macro low, this is the 50%. You could see we are in a range. What is the premium and discount of this range? If you're like, I want to get in now, I want to find a better, I want to get in and I think it's going to go higher, boom, where are we? We are at the 50%. So it's not a bad idea to go buy here, get a trade here, maybe if it goes down, add more down here, add your last bit. If it gets down here, get out and wait until we get here. And then when price gets here, get back in. But now you're saying like, but when you get out, you're losing money. Yes, but this is where your risk management comes. How to stay in the game long, because you will be wrong. You will lose money, especially and as a beginner, you're gonna be losing. You're gonna be losing. But later on, I'm gonna give you tips on how to stay in the game longer and not completely just lose a lot of money, how to be good at losing, if that makes sense. Okay, so now that was a little bit long-winded explanation about structure, why it's important, and a little extra note that when you find your range, it's good to just mark it out because the 50% range helps you keep buying at good levels. Find the premium discount of the current range that you're trading. And I would recommend one of my rules to prevent me from buying at premium. Do not buy in premium, only buy in discount. And if you are going to buy in premium, as in up here, very light. Don't go heavy on the buy, just go light and expect to build down, but keep your invalidation tighter. Okay? Hopefully, I didn't just completely just throw you guys off, but okay. So now that we found the levels and the ranges, currently right now, like we just said right now, we are in the 50% of the local range. Locally, we are at the 50%. Macroly, we are in major discount. So either way, if you're going long here, it's not a bad idea. You're more probably on the higher term time frame currently, higher chance of gaining a good trade of going long here. But anything could change. Remember, we could go straight down and close underneath here. If we close underneath here, then that changes. So I hope when I'm talking, I know it could be kind of confusing, and bear with me. This is my first time teaching this stuff, but I want you guys to focus and emphasize on the thought process. I want you to focus on how everything I'm saying is if this happened, then that. If this doesn't happen, then this. Okay? always be ready for every scenario. If you're prepared for every scenario, then when it happens, you're not like, oh fuck, I'm scared, you know. Okay, so now since we have our levels, we're gonna get into order blocks. What are order blocks? Okay. Order blocks, you identify order blocks with structure, okay? And this is why I'm going very anal about structure, because a lot of my indicators and key zones is based off market structure. Um, okay. So these are order blocks, and this is an imbalance. So real quick, order blocks are at the highs of the range or the lows of the range, and they're usually created once the trend shifts. Okay, and then in between the trend, you know how when market's consolidating, they're going to create an order block. When market is trending, they're creating imbalances. And remember, we need to identify if price is attacking, generating, or rebalancing. So you see why I use these, right? Because now when I think we're rebalancing, then I could target the imbalances. So a bearish order block, meaning an order block that is gonna, if market's gonna trigger its memory and market makers are gonna want to sell out of that zone, a bearish order block is resistance. So, okay, usually it has this type of structure. The last high, the the last move up, this move up before breaking down, breaking structure is your bearish order block. There's a clear one up here. And marking order blocks is a little difficult in the beginning. It took me a while. Everybody marks them differently. I'm gonna show you two ways to mark them. If you want to be very technical with it, then just zoom up. And if you go back to the market structure part of the video, where if you pay attention to the first version I taught you with the technical structure, where you with the two candle pattern, and you don't take the whole move, you just take the two candle pattern. This is where it reversed, right? Because look, this high and then straight down. So what is the two candlestick pattern? A low, move down, and a move up. This is your low, boom. And remember, we're going high, so this is a bullish order flow. We're going in an uptrend. This is the break that created this move down. Okay, so you gotta look for that break. Once you find that break, which is right here, you take the last move up before confirming the break. So since we confirmed the break with this candle, now you would take the low and then take the high of the last move up. That zone is your order block. And the reason why that's your order block is because market makers, before they move down, what do? They move price up, then move it down. If price wants to go up, they first move it down before they go up. That's why you see on the lows W's and at the highs you see M's. So and if market makers are not ready still, they don't have enough liquidity on the upside to push prices higher, when price gets back to the zone, they're going to reject from that zone again, because that was the optimal fill. That was, remember, they trade at the highest and the lowest points. So you take the low, which is right here because it is a move down and move up, move down, move up, the low, and from the high, which is move up, move down, which is this right here. This zone right here is now your order block. Okay. That's your order block. Now, let me show you an example of how this works, right? Boom, 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 boom. Okay, right here. So before, if you see, we're in an uptrend. What do we do when we are in an uptrend? We pay attention to the lows. boom, low, low, boom. We broke it. Remember, this was a full candle close now. So now we take this low, the last move. Remember, for a bearish is the move up, not the move down. So now we take this low all the way to the move up and move down. When marking order blocks, it's fine. You need to take the whole move. It's not a two candlestick pattern. You use the two candlesticks to see what points you mark it from. Okay, this two candlestick pattern low and this two candlestick pattern high, and look what happened. Price went and rejected again from the zone. Okay, um, people could say this is supply demand. This is just how I do it. Okay, people have million definitions for things. Okay, but the logic of why my logic of what price is happening here is that market makers are not ready to bring prices higher, so they're gonna get people to believe that prices are gonna continue higher and then refill the orders again to go lower. Because something that you don't realize, the people that have the money to move markets, billions and billions of dollars, they can't just, hey, I'm gonna sell my whole billion here. They can't do that. There's not enough buyers. Remember, for somebody to sell, there has to be a buyer. Okay. And that's why there's moves like this to get people to be like, oh my God, we're going higher. And they buy, and then their buy is like perfect. Now there's enough people buying for me to sell. Then they sell into it. And then if the amounts of selling cannot absorb the amounts of buying, then that's why it moves down. Okay. That's how price moves. That's how price works. Okay. So that's my logic of why this is happening. Okay. Let's see now, mark bullish one. So are we there yet? I mean, I know we got one here. I remember the ones in between are imbalances. This is one move up. So the strongest order block is always going to be at the very low. So if we're going to take our macro levels, this is the highest order block on the macro high. And let's go down, look at the macro low. What's going on down here? We were in a downtrend. If we're in a downtrend, what do we focus on? Highs. So let's go high. Move up, move down, move up, move down. Boom. Move up, move down. This is a big move up. This was not break a structure. Remember, it's a two candlestick pattern. Move up, move down, take the highest point. It was up here. It was a wick. No break. Boom. Move up, move down. Okay. Move up, move down. Boom. Now this is a break. We got a break, and look what happens. We now shift structure. On the next part, we're gonna go over how to confirm this. Because remember, just because there's a break of structure doesn't mean let's go long. No, sometimes it continues lower. There's always fake outs. So now this is the high that sorry, I got distracted with something. My bad. But this is the last high that broke structure to the upside. So for a bullish order block, you take account to you mark out the move up before the move down. So for a bullish order block, you take the move down and then the move up. Okay, so what's the down move? This is the high, and this is the low, the most recent low. So now you take from here, here. Now this is your bullish order block. Oh look, we tapped it. Once you see that, once you look at that, imagine if you had a limit order here, if you had this concept already and you're just wait and be patient, look what happened. If we marked this level on a long time ago when we moved out of here, you would have known this huge drop. If you were going short, you'd be like, okay, what is the most extreme order block down below if you marked out this structure? Because remember, you would have had this macro low since it was created, because you would have zoomed out and you would have saw, okay, this is a significant part of the chart. So you would have known this area is a huge point of interest, and you would have got a pretty decent trade. I mean, if you had a limit order, I mean, we exploded up 17%. Like, come on now, like you could have made a decent profit. It's up to you if you took profit or not, but that is a good trade. Okay, but again, just because we tapped it, it does not mean now that is the low, we're going higher. Okay, what this means is that the market memory got triggered, and this was the last zone where they bought off of from. Remember, we exploded up. If the order block has a strong reaction, if you see this, just if you can mark a trend line like this, if you can mark a trend line like this and it's pretty steep, that means price exploded out of there. The market makers did not get enough time to fill the orders. And remember, was a small little range. They did not get enough time to fill all their orders. So what really just happened here was that there's still a bunch of orders that hasn't been filled yet. So that's why there's a huge wick. It tapped it and immediately went up. Now the question is, was that enough to push prices higher from this area? Or do we need to fill more down here, and maybe we need to take the macro low and then we move higher? Okay. So now we know how to mark bullish and bearish order blocks and why they're important, and why the technicals on why they move the way that they do and why they're important. Because the whole point I'm trying to find here is where the big transactions are happening. Um, you want to follow the waves as much as you can, or catch it when it's looking it's going to reverse. Those are the two options you could do. All right, so let me clean this stuff up. Okay, and then we got example of bullish, bearish. Now imbalances. Imbalances is stuff like this. All right, let me turn all this stuff up. A very clear one are these. You see how we are trending down? It's just straight, just boom, 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 boom. This is an imbalance. Usually, stronger imbalances are imbalances that have not been filled. Okay. Remember how I said this is technically rebalancing? To confirm that an imbalance is rebalanced, price needs to tap into it again, and which it did already. Price did tap into it. So I don't really pay attention to this imbalance that much anymore. Now the imbalance that's important is this one, because this imbalance has not been tapped yet, has not been touched into yet. So technically this whole zone right here is an imbalance. This is a possible, if we explode from here, when we are analyzing what is price doing, we are generating, and if we break out of this high, we are going to start attacking liquidity, but we are attacking into imbalance. So in this area, are we going to generate, or are we going to rebalance the imbalance and continue lower to attack lower liquidity? Now you see like where the mental checklist is kind of going on how to read price. Okay, so now let's get into volume profile. So volume profile is a tool on TradingView where you could find it is go here and right here, fixed volume profile. All right, I'm just gonna show you how it looks. It's this. Mine are gonna look different from yours. Let me give you the settings. Here's the settings that I use. All right, the colors doesn't matter. Just know that the white one is the POC, um, points of control, meaning that in this current this current profile where I started from, which is from this low to here, in this level, a lot of contracts were traded. And the value area high means this is where, in this current zone, not the whole market, in this current zone that I marked out, this is where it's expensive, premium. Down here, it's where it's a discount. Boom. Now, if you mark it with the what I said about marking the range and marking it 50% and only taking a trade here, now it gives you more confluence because now we're at 50%. So now you know if we get down here, it's a major discount, and you could go long here, whatever. And how to read the POC is if price is above the POC, um, more than likely it's going to attack the value area high. If it's underneath, it's going to go lower to value area low. The POC is down here. That means a lot of people are, there's a lot of contracts being traded here. And if a lot of contracts are being traded near the value area low, what does that mean? People are buying at a discount. So more than likely, it's going to go back to a premium. POC might change to up here, And if we can't get higher, if we start rejecting underneath the value area high, then we're most likely go back to the POC, and from there, either we're gonna rebalance, continue lower, or that was just the rebalance to go higher. Okay, so that's the beer basics. Value area high, look for shorts. That is a premium. Value area low is the discount. Look for longs. Sounds very simple. Okay, POC is where current major contracts are being traded, where there's a lot of trading volume. And if you go into the settings and you do the extend right means that every single candle it's gonna keep on updating, because when it's fixed, it's only staying in that zone. So the reason why that's good, because sometimes when price is developing, the POC might change to up here and price starts trading underneath. And if you do see that, if you see the POC shift and now you're under, like let's say right now, the POC, so you could visually see it, I'm gonna take it off. Um, let's say, make this shit white. Okay, POC is right here, right? And let's say we're going up and down here, and then the POC shifts to up here and price is underneath still. That means that is telling you, if the POC shifts and it's shifting on each low, like if it's making a low like this, like, okay, where the fuck, and shift, and the POC is following it underneath the lows, that means people are buying at a discount and wanting to go higher. But if, let's say, price is like right here, right? POC is low, low, but we are right here and it's still underneath, but out of nowhere, the POC shifts up here, the value area high goes higher, value area low goes lower or higher. That means now the contracts are being shifted. If price is underneath the POC, aim for the value area low. If price is above the POC, aim for the value area high. Okay, but sometimes you will see that. Sometimes you will see it's staying on the low or it's right in the middle. If it's right in the middle, then we're not really sure. Once you start seeing price getting out of one area, then you can kind of see where they're kind of want price to take it to first. But the POC kind of gives you an idea of where price is going to go from this current range. Okay, don't be like, oh, POC just went underneath. That means this is the low that's going to break the high, and then we're going to go higher. No, 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 no. Just see it at the current moment. When you're going and analyzing price, do not marry an idea, okay? Because, like I said, nobody could predict anything. The only thing you could do is react, right? Right now, my ideas of thinking prices are Bitcoin is not going to make a new all-time high could change depending how price develops. I don't know. Like it just really depends. Right now, in this current moment, I don't think Bitcoin's going to make a new all-time high. I do think Bitcoin's going to have a pump from here. I don't think it's going to go lower. I think we're going to rebalance, make a new higher low, and go lower. Okay. So, in conclusion, these are the three things that I would for key levels. So, your key levels are now obviously your value area high, your PLC, your value area low, your local lows, your local highs, your imbalances, your order blocks, and your macro highs, macro lows. Those are your confluence areas. Those are your key zones where you should look for a trade. Meaning, right now, since we're close here, depending on your strategy, or I mean, not strategy, depending on your risk management, you could look for longs here. A simple long, like, oh, I'm gonna buy right here since we are 50%, we are near the value area low. This could be my validation, and then target the value area high, because the one thing that is good about the volume profiles, I will say this, it's pretty reliable that it will always tap these levels. If you're at the value area low, it's gonna eventually go to value area high. If you're at the value area high, it's eventually gonna go to the value area low. It doesn't happen all the time. Sometimes that might be the low and it just completely explodes up and it never comes back, right? But if you're trading a range, it's a higher probability that's going to happen. Okay. So those are your key levels. Those are your confluences, and why they're my confluences, and why those are areas that I pay attention to. The order blocks imbalances are give more weight to my analysis of what price is doing. Um, on the macro sense, the structures, highs and lows are obviously important because price needs to attack liquidity to go anywhere else. Price does not move if there's no liquidity. And yeah, and then the volume profile kind of helps you find the key levels in a tighter zone. And another thing, you could even do it. This is for this area. You could look for the volume profile here. Usually, I mark it from the low to the high. So, and this is why I always say mark the structure first, so you know where to pull it, because you could pull it from down here, whatever. But you could pull it like if you don't care about, if you're only going to be trading and be paying attention for a little bit, then for my swing traders or people that are only going to look at it once a week, then yeah, like fuck what's going on. Who cares about all this right here? Okay, this is pretty much how I'll do it. Levels. If I were somebody that was wanted to only look at my trading once a week, then I will mark this macro level. Boom, mark it, and then I will do the volume profile of this whole level. Boom. What do you see? We are in major discount. Okay. So how you would trade this? Where's step two? Okay, boom. And we had this volume profile here. So now this is in this whole range. What this is telling me is that this is where right here is where the most contracts were traded. So if we're gonna rebalance, which you see how it's close to that rebalancing zone, but you're like, oh wait, but the POC is above the rebalancing. Remember, then that will give you more weight that this most likely going to be a wick. Remember the wicks, SFP, wick, wick. So you can see price do something like this. If we're going to continue the bearish order flow, we're going to tap here and then start rejecting lower. So how I would trade this is that don't pay attention to this volume profile. So I will hide this one and only pay attention to this one. And once you see price exiting from value area high and going higher and tapping the 50%, then that's when you would start paying attention to this volume profile, because now when you're in the 50%, now you're a value area low. And if price cannot sustain itself and it completely rejects out of this, bad news. So in a way, volume profiles give you nice support and resistance. Okay, so you could technically, um, sorry, I keep on using the wrong tools. You could get a buy here, target, obviously TP here, but final TP at 50%. And once price gets here, right, price gets here and you start to see it break structure locally on the smaller time frames, and then you could get out. Okay, but see it as like volume profiles are areas of interest within the range. Okay, strong support and resistance. When you see stuff like this where it's like the 50% and the value area low, these are very strong zones of reactions. This is where you're going to get a bunch of wicks, like stuff like this. Okay, and remember, price could go all the way up here. This, what this is telling me is this: I am not gonna entertain all-time highs until we get above the PLC. There is no reason to be looking at all-time highs until we get above here, because we could easily come here, reject off that, continue lower. Which, what is this now? This was generate liquidity to rebalance an imbalance to attack liquidity lower. Okay, so volume profile, support, resistance, easy areas to notify, premium and discount, imbalances, order blocks, highs and lows. Those are zones of interest. Those are your confluences. Those are areas that you should look for trades. Going into confirmation, there's two indicators that I will have you guys use, and I use the reason why I'm giving out these indicators because this is what I use a lot, and a lot of my trading uses these indicators. You don't have to use these. These could work in all types of trading, scalp, swing, day trading, whatever. But the two is vector candles. Go up here, search up vector candles, boom, use that one, and then um, 50 EMA. I don't want to put too much. Oh, sorry. 50 EMA. Just for example's sake, I'm going to take away the one I have. Just for example's sake, I have 50 EMA. Uh, you see how there's a bunch, and it's hard to find like just 50 itself. So let's just pick the lowest one where it doesn't have a bunch, like 50 and 100. Now, double click it, plot. Okay, I don't like how this one doesn't say which one is the 50. A really easy way to find out which one is the 50 and which one is 100. If you click down here in the corner, oh, let me move my face. Let me move my face, it's in the way. Okay. If you click over here in the corner, whenever you put indicators on, you're gonna see this little two, or it might be already open like this, okay? This just means you're hiding your indicators. Let me see where you can really see it. So you see this is vector candles. Now go to the 1500. If you look closely, um, the red is pretty much whichever is first is that EMA. So since the first one is 50, that means the red line is the 50 and the 100 line is the 100. So you just double click it and take away this one, right? Okay, yeah. And now this red one is the 50 EMA. That's the one that we need to pay attention to. We could use the other one, but I'm not gonna get into that right now. That'll be a different video. This is what I'm gonna be showing right now. Um, but I like to have it as cyan or blue, whatever color you would call this. Change the thickness. But those are the two indicators that you're going to need for this part of the confirmation. So a little quick explanation of what these are. 50 EMA means exponential moving average, and the 50 means in the last 50 candles, what is the average price in those last 50 candles. So pretty much meaning in the last 50 daily candles, because when you change time frames, this changes also. On the daily time frame, in the last 50 candles, the average price is 92. That's pretty much what that means. Okay. These vector candles. So what the vectors are is pretty much tick volume. Tick volume. A tick is the point price moves. When price moves one, like let's say $1, that is a tick. And that's pretty much what it is. And what this is telling you is that the red vector candles are, um, let me look up the exact. Okay, so right here it says a red vector. So you're gonna see four colors with the vector candles. Okay, you're gonna see red, green, and violet and blue. Green and red means the strong ones, like that is the most volume. This means it's less. Okay, so right here it says for the high volume, meaning the red and the green, it's 150 to 200% more tick volume, meaning there's a lot of sell transactions being transacted here. Remember, a lot of my logic and a lot of things I'm saying is market makers. So one thing about the vector candles that are really good, it kind of gives you the clues where market makers are at. Okay, and a lot of my logic is I want to see if the market's gonna trigger its memory, and I'm trying to see where the market makers are transacting. That is my whole basis of my strategy. So when you're looking at this chart, let me take out the EMA and leave the candles. What do you notice? I want you guys to just look at the chart, and I want you guys to, when you guys have the vector candles, to even test this yourself. Don't just take my word for it. I want you guys to test this. Um, what do you notice just from right here? Oh, price recovers the candles. So not only do the vector candles give you clues of what market makers are doing, but price always recovers the vectors. So that the vector candles are also another confluence of zones of interest, because if you know that zones always get recovered, like whenever I was here and price was moving forward, I knew that once price was getting ready to reverse down, these zones are now um, zones of interest. Or if I was in a short, these are profit targets, right? Whoops. Okay. So when you see these red vectors right here haven't been recovered, this is a zone of interest. This is telling you that once we break out of this high, then we are for sure recovering this. And if the highest point of these two candles is here, and only take the body. Only take the body of the candle. Don't pay attention to the wick. So since the body's here, what also aligns with here? Oh, our imbalance. So then this is telling you this zone, when things line up like this, that's the more things that line up together, the more weight that has. Okay, so now this is telling you if you do see a strong rejection here and reversal, and it recovered everything, oh, that means they're not ready. They're not going to recover this yet, and they're going to continue lower. Okay, and let's say you target a long here, you buy long here, then it's an easy profit target. Okay, I know that since they always recover the vectors, this is an easy profit target. You're not going to be like, is it going to go higher? Is it going to do this? If you just organize all your trades on recovering vectors and targeting highs and lows, it's easy profit. Like you're not going to be like, wait, is it going to go higher? Is it going to go lower? Or what is it? What is it? No. And also, you could use it once. You could use it also as pullback areas. Like let's say right here, we're waiting for this high to break. This high broke with a vector. When you're right here, oh, sorry. If you know that price always tends to recover, then you don't buy until you see this get recovered. Once you see this get recovered, um, it doesn't get recovered fully, but it needs to be at least 50%. If 50% gets recovered fully, then you could look for a buy. And look, that would have been a profit, but of course, ended up being a loss. And this is why your risk management and what your plan is really matters. But you could see this happen all the time. Like um, this significant high, we broke, boom, and we did end up recovering 50%. We recovered more than 50%. If you just wait until the vector gets recovered and look for a buy, then it's going to be usually a nice position to be in, because the market maker is always going to get the best fill, and they're always going to buy where they bought, because they know where they bought was the lowest point, then they're going to buy again there, right? And another thing that you could use the vector candles for, which is going to be one of our confirmations, is that whenever there's a level, even you see it here, you see it here, here, whenever you get a break with a vector, that is a strong break. That is telling you it's going to go higher. Break with the vector, it went higher. And this is an example where it doesn't happen all the time. But if this, if you get a vector break in a long consolidation, because look, it all really depends how much time, okay? One thing I really need you guys to understand is the more time price stays in one area, the more it's generating liquidity, right? Mind you, this consolidation zone, where is my, was 200 and 244 days long. It broke with a strong vector here. This would have told you, oh yeah, let's go long, and which it was, amazing, an amazing trade that would have been. So, but look how much time we spent consolidating, consolidating, consolidating. This one obviously wasn't as strong because look, we only spent what, barely a month and a half here, rather than almost a whole year here. So the less amount of time price spends in the area and it breaks, Don't take it as like, okay, we're gonna explode, we're gonna fucking go crazy, okay? Unless, especially here, when we are at the highs of the range, if you're down here, because this also wasn't a long consolidation, but if you look to your left, we are we are in the downtrend. When you are right here, we are in an uptrend consolidating higher. Okay, so I'm not saying that you can't go long, but keep your expectations lower. And if you are keeping with the logic of premium and discount, then if you follow those rules, then if you saw this consolidation and you notice that, hey, I am in a premium, because let's take this tool to mark out, hey, I am in a premium, I'm gonna go light. And if you went light, even though that would have been loss, it would have been a light loss. It wouldn't have been a devastating loss. Okay. So vector candles are clues of where the market maker is transacting, um, and also target for profit for TPs. And also, it's good places to see where market's going to recover. So if we are expecting, how I am right now expecting a break out of here to attack liquidity to the upside, but in reality, it's just going to be a rebalance to continue the bigger trend, then it gives more weight with whenever I'm projecting price, it gives more weight of this idea, okay, instead of this idea, which I don't think we're going to come back up here yet. I don't think we are going to get up here just yet. The only way that I would change my mind and think we're going to get up there is this. Let's say we recover this, but on this move up, we created green vector candles. And what happens when you create green vector candles? Price always recovers. So when you see price going to do a pullback, target the green vectors. Oh, price is starting to consolidate and pull back. Oh, we could cover 50, consolidate, pull back. We recovered 50. So if I see a green vector, we start consolidating, recover, pull back, and then we see something like this, where on that, oh, Jesus Christ, on that recovery back, we break this high and now start a continuation trend, then I would target up here. Then I'll be like, okay, this gives more weight for this because um, this is internally in that leg. And remember, on the macro, we are in an uptrend. Remember, we don't lose the uptrend until we lose this level. So then this will confirm this is the pullback, this is the swing low inside this huge move leg up, and now we're going to continue higher to target here. That's how you need to see it. Trade level to level, figure out what price is doing, and trade towards what is doing, or wait to see where you're targeting to go and wait to take a trade there. Okay. So again, vector candles, use it as, and the reason why it's confirmation, because if you have a high here and you get a green vector break, that's confirmation. Get in the trade, and this is why this is part of the confirmation part. Also, not only do they give good confirmation, it also gives you clues of where they're transacting, just like up here. This was a red vector, and this is also the bearish order block. If you see the vectors inside order blocks, with my logic of order blocks, you remember, is that market maker is gonna move price up before it goes down, or before price could go down, it needs to move up and then down. Before it goes up, it moves down, move up. So this is the uh, market makers quickly moving price down to get people to think that, oh shit, this is a reversal where we're going down now, but then it quickly moves up, fucks those people over, or gets people to believe actually no, this is a pullback, and then continues down. Now that's an order block. But if you see vector candles inside and breaking away with a red one, strong zone. That's how you could put more weight with your order blocks and imbalances. Same thing with the imbalance here. There's a vector candle in the imbalance. So that tells you there was a lot of transactions there. And remember, the only people that could do this, mind you, the only people that could create these type of candles is not us. We don't have that power. We don't have that type of liquidity. That's only big players or market makers, period. Okay, so now the next thing that is on our confirmation is the 50 EMA. The reason why I use the 50 EMA, I'm not really sure. That's just what I've been using, and that's what I like to use. And yeah, it's just what I'm used to. Okay, so this is going to be for the people that are swing trading. This is a very simple strategy, very simple entry model. If don't don't look to buy price until price is above the 50. Okay, don't look to buy until, like, if we're in a consolidation, wait until price gets above the 50 and buy. If price is below the 50, look for sells, or don't buy at all, wait until price gets above and start looking for buys on the pullback. It kind of helps you keep the overall what is currently doing. Look at the 50 EMA as momentum. If it's sideways, that means we're consolidating. If it's going down, that means the momentum is going to the downside. And if you see the momentum going to the downside, if you see price under the 50, then target these. If you see price above the 50, target red vectors. So like if, yeah, yeah, I think that's pretty self-explanatory. So since we're underneath the 50, we're going to target these. That price is going to keep going down until we get above. So a very simple entry model is wait until one, price closes above the 50, but even more if you get a green vector candle close on the daily or any time frame, because you could see this happening on any time frame. But if you want to be certain, a really good probability trade is wait until a green or red vector candle breaks the 50 and then look for a trade. So like right here, green vector break, boom. You see, and this is where your risk management habit, because it doesn't happen all the time. Because right here, you would have got the green vector, and then let's say your trade was down here, your let's say you got in on the break, your invalidations here, you're targeting this recovery. That is still a winning trade, because if you just stick to trading vector to vector, you have a higher probability of being in more winning trades. The only way, if you're trading vector to vector, you will get a losing trade is if you don't take profit. Always take profit. Nobody goes broke taking profit. Okay. Um, Rather than like trading for the high, because if you're aiming for this high, it would have never got touched, right? And you would have just held to a loss. But if you trade vector to vector, you are more likely to have winning trades than losing trades. Okay. So technically, if you're going with the logic of I'm waiting for the 50 break and I'm trading to the nearest red vector, this was a win. Right here, you didn't get a vector break, but price started trading underneath the 50, then you could have started looking for shorts and aiming for this right here. Or down here, which in this move down, we did hit the vector. You see, break, if you're underneath the 50, target the green vectors, which if you saw this break, retouch, okay, what is the nearest green? Here and here. Okay, I'm gonna go to a short trade, stop loss up here. Once it hits this, I'm gonna take 50% profit. If it's down here, I'm gonna just close out fully, which that would have been a successful trade. You would have waited, we got above the green. This, technically, you could have got, there was no recoveries here. So this is kind of, if you're sticking to the daily, because if you zoom in, you're gonna see recoveries in all time frames. But if you're gonna stick to the daily for my swing traders, even though we got a strong break, it wasn't a vector, but even though this looks good, like, this tells you there's not a lot of weight behind this move. There wasn't a lot of transactions, there wasn't a lot of tick volume. So this is just a fake out to go lower, which it did. It made it, which was a rebalance to go lower. And also you saw, I'm not gonna go too deep. I'll, whenever at the end of towards this course, I'll bring it all together. But same thing, red, red, red vector break. If you got in on the break, let's say it closed right here, then you target the nearest low, just right here. Boom, recovery. Right here, got in, bought, long. and especially it's a green. Let's say your stop loss is underneath the most recent significant low. You want to target which there is recovery right there or right there. But let's say you're not going to get perfectly. Let's say you're going to get right here, right at the close. Now, this is something where if you had this, technically this was a winning trade. This is a winning trade. But this is a shitty trade. You're telling me you spent more time in red than high and only for a shitty reward? Now, this is where the premium and discount, this is where finding your range, because if you were in your range, if you had your range marked out here, you would have realized, okay, even though this is a break, we are in premium. I'm gonna go light. And if you went light, you could have added extra more here, brought down your entry here, and still be underneath this low. And then when you saw this break, you're like, oh, bet, like, um, extra confirmation again. You could have added more to your entry to target this high because it hasn't been taken yet. And then boom, 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 and that would have been a winning trade. Final TP, whatever. So I hope you started to see how like everything that I'm talking about not only helps you look for key zones, but also helps you not make bad decisions and not buy in bad areas or sell in bad areas, or if you are going to buy in bad area, to go light or to not go as heavy. Okay, so your confirmation is a green vector break um, of the 50. That is a good confirmation to get into a trade. And another confirmation to get into a trade is price is trading above the 50. If I were recommending you guys, because the higher the time frames, the easier it is to see, but the only problem is that it takes longer for it to play out. So I'll recommend you guys to stick on the weekly, because if you stuck on the weekly, the first vector break, that was pretty much the bottom. Okay. Right here, this is pretty much telling you do not DCA until we get above here. Period. Do not DCA. Do not. If you want to play it safe, you want to be safe and not like, you know, you're not that advanced to monitor and know when a validation is, because in the beginning, you're not gonna like to lose. So a lot of times beginners hold the trade. They hold it, they hold it, they hold it, they hold it, and they can't handle the pain no more, and then they get out. So if you're in a DCA, wait until you're above the 50. Wait for the red to green vector break above the 50. And if you want to be a day trader or a scalper, it happens a lot on the lower time frames. But of course, remember, the lower time frames you get, remember the trades are shorter and you're more prone to lose, okay? Okay, so this is the 4 hour. If you're right here, what is the rules? If we get a red vector break of the 50, then that means price is going to start going down. Red vector break. And if you literally got on a short on this candle close 4 hour, you pretty much got the top of the market. See, boom, just went straight the fuck down. We already went around how green vectors breaking a key zone, the 50 EMA, went to do DCA, why that's confirmation. Break above the 50 means the trend is shifting, the momentum is shifting upward. Look at the 50 as momentum. Look for 50 vector EMA breaks on consolidations. On trending, look for a rejection. So if it's trending down, look for price to go back to the 50 and then look for a rejection down. Same thing when it's trending up, look for a price to go back to the 50 and get a bounce out of there. In consolidations, wait for the 50 break to whichever side, the green or red. And also, if you have a high and you get a vector break out of that, that's confirmation also. So how this was look. Also, another confirmation is breaker structure. Simple as that. If we hit like for example, let's go back to our thing right here, where how we had this order block. um, this order block right here, and we tapped it. Boom. We hit our key zone. Okay, now I'm looking for a break of structure. We hit king zone, key zone, sorry. And if you go back to the time frames of swing trading, what do you do for execution? Let me just go back. For swing, you go on the 4 hour or the 1 hour. So now you zoom into your 4 hour. Boom. Let me turn these off. Oh, whoops. You zoom into the 4 hour, and let's say we just tapped it. This is not here. All this price right here is not here. We are right here. Okay. So right now, what is your current range? Is this? This is the most significant high. We can't talk about higher prices until we get above that high. This is the new low. We tapped our order block. So now, what is your current structure? Is down. This is your most. If you're on a downtrend, um, what do you need to pay attention to? Your highs, because if we can't close above the highs, then you're continuing on the downtrend. So this is move up, move down. This is your most recent high. Let me make that smaller. Move up, move down. Move up, move down, and then boom, you get that break of structure. Then technically, you could enter here, enter, because we tapped a key zone, and this is the first break of structure away from that key zone on the lower time frame. Remember, on the daily, it doesn't look like this. Jeez, I always press the wrong one. Remember, this is all hindsight. In hindsight, everything is easier. But I hope what we're trying to get is, if you don't know how it looks like, then how are you gonna look for it when it's developing in front of you? Okay. And then target up here. Let's see if there's any vectors above. Oh, look, vectors. You could easily target these vectors. Um, let's say about the 50 EMA. Where is it? Okay. So now you go also. This would be a safe one. So if we're still on a downtrend, mind you, this break does not mean we're going to all-time highs. You need not only a break of this, but we need to get above here to confirm that, okay, we are reversing. This could easily be, okay, we broke. This could easily just be the rally up to continue lower. But this right here is a valid entry. It's a valid entry. We broke structure. We pulled back. We have vectors above. Also, we had a green vector at the lows. One other thing too, getting green vectors at the lows is a good sign. Getting red vectors at the highs is also a bad sign, because they're selling at the very top. Remember, if market makers buy and sell at the best price, what is this telling you? Oh, market makers bought at the very low of the low. And if you zoom out, this was the low of the low. That this would have told you, okay, they're starting to buy and we're in a downtrend. Bet. Of course, you're going to see them in the middle, but this wasn't too bad of a drop, right? We're still technically in this big wick. We're still barely at this wick. But being down here is a whole different story. Look at this drop. It's been, the longer price is moving at one direction, the more weight these signals get. If price hasn't been moving down and you get that signal, I'm not saying it's not good or it won't be a good trade, but if you get it at a strong move down like this, it's a higher likely of it being a massive trade. Okay, we've been going down for pretty much 45 days now, for a whole almost 2 months straight, a month and a half straight. But we got the confirmation because we got the break. Stop loss at the nearest lows or at the nearest local low. Target this first TP, final TP there, and then boom. If you saw this, you probably would have added extra to your trade and took TP here. Now, right here, obviously, this red vector would have been your clue because we would have got red, red. If you're getting multiple red at the highs, remember, now that this is your range, we're at premium. So if we're getting red at premium, I'm not saying you should get out immediately, but start looking to de-risk or take profit. Okay, always take profit. If you're in the long, take profit on the green vectors, and if you're on a short, take profit on the red vectors. Not only look at vectors as targets, but also look at points to take profit, because you're not going to know if it's going to go higher, you're not going to go it's going to go lower. But if I saw this move, me personally, even though it broke the 50, I would have still taken profit. I would have taken like 25% and let it ride. If I saw this one, boom, another 25. If I saw this red, okay, it's looking bad. Saw this green, and if I saw this red, I'd be like, you know what, I'm probably going to put my stop at break even and see what happens. And that would have been a successful trade. But this is a that would have been a week long trade, a swing trade. Okay, so my confirmations is breakout structures, vectors, or vector break 50 EMA. Okay, to confirm an SFP, you need a liquidity sweep, which is a wick, and then price to close underneath its recent low. That is the confirmation of a SFP. Okay, so right here, you would have saw that even though we got a wick after get that first wick, this move up, move down. I don't know, you can barely see it, but that's a black candle, which is a down candle. I would make this the new high. And what happened? SFP the new high again. But I will not go short here. What I will wait is for a candle close its recent low. Right there is the recent low. But after this candle got created, because remember, move down and move up, this is the new low. So after this close is the confirmation of an SFP, meaning we're going to go a lot lower. You could have got in here and just targeted. I'm pretty sure this was a vector, right? Yes, vector. You could have targeted the vector, and these happen all the time. A SFP, then a breaker structure, is always a strong signal of continuation. It happens all the time. Okay, even right here. SFP, where is your it wicked it? Your nearest low is here, but the new low got created right here, and it got created right here. Break. So now, after you wait for SFP, you could either get on the break or wait for a rebalance or tap of the order block. Remember, the last move up is your order block. So now you would have broken down, wait for the bearish order block, and if the market's going to trigger its memory, it's going to go lower, which it did. This is an example of a inside of a range. Um, I know it looks easy in hindsight, but this is the bare basics idea. Okay, remember, order blocks get created once trend shifts. Remember, there's trending in all time frames. And there's right now we're consolidating, but technically this is an uptrend, downtrend, uptrend, downtrend. But if you zoom out, this is consolidation. Even right here, even though we are moving down on the daily, but inside this little area, there's a little mini uptrend, mini downtrend, mini uptrend, and even inside those areas, the order blocks and stuff like that get created. But that's of course for your type of trading. There's no point of looking at this order block if you're swing trading or stuff like that. This is mostly for like day trading where you're looking for the move of the day. Like if you're here and you're like, okay, we rejected, we haven't tapped this order block yet. So if I want to think, if I'm looking for the trade of the day, if you're down here, you're like, okay, well, before price, it looks like it wants to go down. So before I decide to get in a short, what does price usually do? It moves up and then moves down. So wait, oh, we tapped the order block, and what happened? We tapped it, we broke structure here. Okay, let me get in. Sounds simple. And then turn on your vectors, aim target vectors below. This didn't get fully recovered. You could have targeted that. Best confirmation to give a conclusion Your SFP breakup structure is the best. If you get vectors breaking that breakup structure, even better. Another confirmation is vectors breaking the 50 for buying or selling. If you're gonna DCA on the daily time frame or on the weekly, I'll recommend for you guys, the beginners, wait until price gets above the 50 EMA on the weekly, and then start to DCA on the pullbacks. Um, yeah, that's for confirmation. It's the breakup structures, vectors, and also with vectors, if you see big moves like this, wait to recover the 50 and then go in. Always trade vector to vectors. That will give you more higher probability of your trade working out rather than targeting highs and lows or Fibonacci's or stuff like that. If best thing is to target vectors, okay? For continuation, it's fairly easy. Should be this pattern, the continuation pattern, which is self-explanatory. Down, retrace continuation, retrace continuation. You're looking for that overall market structure, but the 50% of the range. So let's say from this low, macro low to this macro high when we were here. Mind you, this is not here. This 50% is also a strong zone, which, oh, look, back to the 50, continuation. And what do you see here on the 50, which is a strong area? Because if we're going to continue higher, the pullback is going to continue back to the 50%. We see what a W break, retrace continuation, right? So for continuation, what you're looking for is a retrace back to the 50, this trace, this pattern, continuation patterns, or Fibonacci. This is the only time where I do use Fibonacci if I want an extra, just extra confluence, just extra zone maybe. So usually I use, um, so I use the 618, 786, and 0.65. So how I use this is from the low to the high. Like let's say I want to look for a continuation here, right? We are right here, and I'll take from the low to the new high, and you see price taps into that area, continuation. From right here, from this low to this high, continuation. For Fibonacci's, I don't use them too much. It's whenever I am not sure. Like let's say in this level right here, I want to zoom in, and we are still technically in a downtrend, right? So in this, we are in a downtrend. So trade towards the trend. The trend is your friend until it's not. Um, then if you're looking for a bearish one from the very high to the new low, like now I'm seeing this as an area of possibly going lower. So whenever price touches here, I'm like, okay, maybe if it can get above this high, most likely going to go down. This could be also 1 2 from this high to this low, and this also goes in line with what the rebalancing, you know, this right here with the imbalance, and how I'm saying, how I think price is gonna go attack this imbalance so it could rebalance itself and continue lower. We have vector recovery, so this is a good area of a rejection. So that's how I use Fibonacci to give just an extra more weight to the area, okay? But don't take it like Fibonacci's don't, I'm not saying they don't work, but everybody uses them differently. They either use them from here, here, from here, here. So I'm gonna need you guys to play with them to, whoa, sorry, pause on that. But for Fibonacci's, it's really up to you how you would like to use them. So that's why I don't recommend for you to build too many trades out of it, out of the fibs, because it's all, what's the word? Subjective, okay? Um, but just like if you're not sure, like, fuck, is this really a good zone or not? Well, let me see, like, okay, let me take it from the absolute high, and let's say this confirms a macro low once we break out of there. Where is it? Okay, well, actually, there's this right here, but the most recent high, um, is right there. Okay, this is a good zone, good zone. Then you kind of get an idea, like this whole area right here has major resistance, because even when you go take it from the very high, it's still, that's the end. So now you could kind of see that this area, this whole area right here, is a place of resistance. I'm not saying like, oh, that means it's huge, right? But it's just area of interest. We need to see how price develops in this area, because we have a lot of things telling us that pay attention here, pretty much. So confirmation is pretty easy. It's simple. Um, like, W break, retrace continuation, or right here, uh, M formation. Remember M, break, retrace, continuation. Technically got a continuation, but I did continue lower, because if you're waiting for the retrace, then you would have got here. Very clear topping pattern. Remember, on the top of a market, what do you see? M's. So right here, clear M, break, retrace, continuation, retrace, continuation, retrace, continuation. All that is continuation. And if you look at each, um, what you call it, from this move to that move, even though it didn't touch the fib, but I'm pretty sure it touched the 50%. I was wrong. It did not touch the 50%. But not all your confluences, not everything is going to be perfect. But at least the main thing that you should focus on is the way that it's structured, the way that it looks, okay? For example, I'm not going to take this out the video because I want you guys to see, like, oh, even some of my stuff doesn't work. And that's why, example, why I don't use the fibs as gospel. What I do use as gospel is um, structure, really, and the 50% of the whole range. So this would have been your new range. If you would have got around this high, it's still technically touched the 50 and continue higher, but it didn't break all-time highs. So when you're looking at the 50, don't be like, oh, it touched the 50, that means we're going higher. Just as another zone of interest, okay? But that is continuing, because if this is going to continue higher, because watch, even right here, because right here the 50 work. This is a macro pull, meaning on a higher time frame, on a very big time frame, because mind you, remember, this was the high of a very big time frame and this was the absolute low. So from the absolute low to the new high, and what did I say? To confirm an uptrend. It doesn't mean just because we broke out of it with a body close doesn't mean that it's confirmed. It could be a fake out or a sweep. So what do you need? You need price to close again above the new high that gets created. So if we're taking from here, from there, from this high right here, we tapped it, boom, but this was the new high. So then this confirmed that this is a confirmed break of structure. But now we take this low to this high. We are now trading underneath the 50, but we're technically still in an uptrend. Remember, because this confirmed on the higher time frame the break of structure to the upside. So to invalidate, we need to close underneath here. So now this 50 is no more the retrace. We're not retracing. And just because we did not retracing on the 50 continue higher doesn't mean it's bearish. It's only bad if we close underneath here. Period, period, period. Take this as, okay, this is a deeper retrace and we're going to discount or possibly to go higher, okay? But overall, the bear base, even here, if you want to boom, retrace continuation. This is still a retrace, okay? But look, it's an M formation. So it really depends. If we continue here and start making new highs, and it was a retrace continuation. If not, we continue lower and break underneath here. It's an M. So now if we break underneath this low, then next expectational order flow, because if we get the body close to on the high time frames, it confirms. So now it confirms this expectation that on the next rally up, it's going to be, oh my god, it's going to be retrace and continuation lower, okay? So for continuation is very easy. Just market structure. Look for 50% and fibs, and also monitor highs and lows. So if you take a short here, what invalidates the structure? If you're in a downtrend, you're looking at the highs. Also, yeah. So now, let's say you take a short here, you just keep on moving this down. Okay, we're going down. Boom, down. Boom. Oh, we SFP'd it, so we're continuing down, down. Boom, down, 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 until it invalidates. Once it invalidates, then you recheck your trade, or reverse it, or take profit, or whatever. But also, SFPs is continuation, because technically here, this would have, if you were already in a short, this would have confirmed the continuation, because it would have been a break, retrace, swept the liquidity, got people to believe we're going higher, and continue lower. Okay. You can also use the 50 as continuation, break, retrace to the 50, continuation, retrace to the 50, continuation. It doesn't always have to touch. If it's getting close to that level, then it also validates it. Before we put everything together and I show you step by step from top to bottom on everything that I've been explaining in this course, we're going to talk about the entry model that I would suggest for you guys to use for swing trading and risk management. This entry model I use a lot for swing trading, and I recommend a lot of beginners, is that you would never buy the bottom, you would never catch the bottom. You're not a market maker, and you're not skilled enough to do that just yet. Eventually you will. So this helps you, instead of putting your full position here, it helps you keep it light. So in theory, this is how you would implement the 2020. The best way to explanation is like this: we're clearly in a range. We are right here. Let's say you have $1,000. Break it up to those four buys. Um, where's my tool? First 20% here. You see it drop down. Starts to get a little strength. 20% here. You start to see strength here. You break here. And you're like, oh, okay, we're gonna go higher. Let me put my last 20. There is your last 20. Right here will probably bring your average entry to like right here in the middle, which is now dead center in the range. Your validation is still down here. You haven't seen this big drop yet. The reason why we saved the last 40%, and the last 40% of your buy, be very strict with it. Do not add it unless there's clear confirmation. Meaning in this area, in this moment, let's say we are right here. Just so it'll be easier to see, we are right here. We are consolidating. Macro speaking, we are in an uptrend. So you are buying because in the macro sense, we are in a bull market. You're like, okay, all right, I'm putting my first 20, we've got strength. Okay, this looks like we're going higher. Right here, it looks like we're going to break all-time highs right here. Now your last 40, you don't add your 40 until you break this high. You break, retest, then you add your last 40. Now all these positions are in profit. Okay? Or if this happens a lot in, at least in the crypto markets, where, I mean, it happens a lot in the stock market in the past year too, but um, whenever you get a huge flash crash like this crash right here, where it swept all these lows and created a new low, you save your last 40 for either a break of these highs or a huge dump down. Right here, you add your last 40. But if you end up adding your last 40 here, on the next rally up, I would take out that 40%, because now you are hedging your risk, because you saw a return on that 40, and also 40% is the bigger size of your position. So now you're gonna take that 40% out and still keep these 320s and see until strength, and then add the last 40. Whenever you put the last 40, always be in and out, in and out, in and out. Don't be 100%. Me personally, I don't like being 100% in a trade, like as in my whole account size is 100% on risk. That's just me personally. But whenever you add your last 40, be, not only do you be strict with why you put it in, and also be more conservative and a lot more aggressive on your profit taking on your last 40. So I will only add my last 40 for big drops like this, because a lot of times whenever there's huge drops, there's always a huge recovery. And it happens often, a lot. So I will only add on drops, or when we get confirmation for sure, as in this high will confirm that we are going up from here. Okay. The thing about this entry model that helped me the most is that in the beginning, I was a professional at buying tops. I was always buying up here, up here, up here. Doing this entry model really helped me to minimize my losses. So instead of putting like my full position, I'm like, okay, it's gonna go higher, we've been going up, I only put 20%. I have to wait for the pullback, 20%. And since I keep my last strict, even if this is a loss, which most likely you will be at you will be wrong. Um, it's not destroying your account. You still have 40 to 60% that hasn't been effective to the drawdown. So this is mostly for safety and also to keep you in the game much longer, because the main thing you want to do is not only preserve your capital, but you want to stay in the game as long as possible, because if you're not playing, then you can't learn. Okay. And I always recommend to actually trade, because you don't get emotions when you're back testing or you're using demo trading. You don't really get that real emotion of having real money on the chart. Okay. So the entry model that I would be suggesting for you guys is the 20-20-20-40 method with the 40%. Always be strict with it. Either add on a big dump and add your 40% there, but also be aggressive with the profit taking for that 40%, or add the last 40 whenever there's a clear break, clear confirmation, clear everything. Then add the 40, same thing, be aggressive with the profit taking. For risk management, it's really depending on your size and really depending on your tolerance, really. And that's something that you can't know until you get the market experience. And that's why I recommend all of you to don't be afraid to trade, put trades down, lose little, and be okay with making a little bit of profit in the beginning, because you don't know. You're trying to gather as much information and know yourself and know what's the most optimal way of trading for you. So what I like to do is break it down lives. Like, you don't have to risk a lot. Like, for this example, let's say your account size is $1,000, right? I know not everybody have $1,000, but you could do it with $500. So um, break up your $500 to 10 trades, and that means if you have an account of $500, if you're breaking it up to 10 trades, that means you're only risking $50 per trade. And if now break that $50 to, if you really want to stay in the game as long as possible, I'll recommend this. Break it to 10 lives. So now each trade max that you're going to put in is $50. That is the max that you're going to put in. So now you know, even if you're wrong and you have all your position in, you know that you're only losing $50. Okay. Now break that 50 to 20%. So that means 3 of those entries are going to be $10, and then on your last one it's going to be $20. So same thing, same logic. So that means if you got the $500, put $10, $10, last 20 here, boom, shift out. Over here with the same example, $10, $10, last 20, boom. Okay. And now you might be thinking, but that means only $50, this and that. Like, but don't be too focused on making money right now. Okay. You need to learn the process and learn how to manage your risk accordingly to your account size. Okay. But as a beginner, I like to break it down to 10 lives, make it like a video game. I got 10 chances. And if you keep with this method of the 20-20-20-40, whenever you do lose, if you're really strict on your 40%, that means you would never lose the full account, because you will only add the 40 if it's confirmed it's going the way of your trade. So in all reality, you would never lose the full 50. You might lose $20, $10, $15 because you would have never added that 40. Hope that makes sense. For this part of the course, I'm gonna be doing the top and down, putting it all together pretty much. The the strategy, the analysis, marking out the levels, the confluences, examples of the entry, examples of trades, risk management, putting it all together. All right, in our strategy, there's four things that we identify: is structure, liquidity, and find what price is doing, or where it came from, and what it's currently doing. Trade towards liquidity or trap liquidity. So if we are right here, let's say none of this exists over here. If we are completely high, what is price doing? Price left these lows. We're in a bull market, left these lows, and what is currently doing? It's attacking liquidity to the upside. And so let's say we are right here. If we are right here, we are obviously in an uptrend. This is a clear uptrend. So expectational order flow on that higher time frame is what? Higher lows and higher highs. Currently, we attacked liquidity to the upside. We swept it, attacked liquidity. So what is next? Either we are going to do two things: generate, or rebalance and imbalance. Currently, we are rebalancing because this is the pullback. So this low is important on this move up. This is a clear imbalance. This right here, the order block at the very high that broke down because locally inside this macro leg up, this broke structure at the highest point. So you would take this move down, move up. This is the low. You would take this low from this candle, and the move up, move down from the high from this candle. You take the last move up and the whole move, not just the candle. Okay. This is where you are. This is your new all-time high. This is your point of interest, your macro low, meaning this would invalidate any type of macro uptrend, but in all reality, it's a big extension move up. If we did go down here, it will look really bad. So in all reality, if there's a huge move like this, this would be your invalidation of the macro bull market, okay? Because on the weekly, let's see how it looks on the weekly. Yeah, on the weekly, this is a clear imbalance. To move down, move up. Okay, so now we identify what structure is doing. We attack liquidity to the upside. Now we're either going to generate or rebalance. Currently, locally, we're breaking down, attacking lower prices, hopefully to be a rebalance to continuation, or it's going to be a rebalance to generate more, as in consolidate here, which that's what did happen in hindsight. Of course, everything's easier in hindsight, but we marked out our imbalance, our bearish order block up here. Let's see how the 50 is looking on the 50 EMA. We are obviously in the uptrend, so we're getting close to retracing to the 50. I can't see any vectors right now. I don't know why it's not showing up on my screen, but there's vector recoveries here. I will show you right now once I get out. So here, what you would do is either trade towards the liquidity to the downside, meaning right now, currently, locally, we are trading down, attacking liquidity to the downside to rebalance on the bigger sense, okay? So either you could do two things: either trade towards the current movement, which is down, or wait to trap to find buys for the bigger movement, since on the macro sense we are on the uptrend. Wait to trap price, pretty much look for buys, waiting to hit either this low or this imbalance. You take this low, you find the 50%, This is also the 50%, so this will tell you this zone right here is a really big zone of interest for possible bounce. Because we have from this swing low to this swing high, this is the 50% right here. Well, right here is the 50%, but also we have this low and the 50 EMA here. So technically, if you were here, what I would do, I would wait for price to hit the zone because we are currently going down. So I want to trap price because it's better to try to build positions on the macro trend. Okay, if you're gonna want to go sell, you can, but I wouldn't recommend it as a beginner. You should try to stick with the bigger move, especially if you have no money in the game. So I will wait till price hits here. Okay, so right now we tapped into the bearish order block. So now if the market is gonna trigger its memory, and if the market makers are gonna want to push price lower, that means in this area it has to go lower. If we break above, then that means a bull market. This is not a strong area of resistance no more. We tapped into it, so now we're expecting either to break above or reject, and we end up rejecting. And right here on the rejection, so if you were SFP, break a structure, this could have been a trade down here. This is your invalidation high, break into my zone of interest to buy. Take TP. Now, since we tapped into that zone of interest, I will zoom in. And look what happened here. Let's see if we could see any more confluences. So even if you zoomed into the 4-hour, what does price do? It either is attacking liquidity, rebalancing the imbalance, or generating. So when you see where price bounced away from, you can see if you zoom into the 4-hour, this is actually an imbalance. So boom, you have your key level. We first tapped into the daily time frame key level. We tapped into it. You would have zoomed in on the 4-hour, look to your left again and see in this zone, do you see anything else? Oh, we have an imbalance. Let me mark that out. It doesn't always happen. It could just reverse from here, but just in case, if it goes lower, go to your left and see if there's any more confluences in that area on the 4-hour. That's the only time when you would drop down to a lower time frame and start to do the same confluences and stuff like that on the lower time frame. Is once you already tapped into a higher time frame, like if this example is swing trading, our analysis is on the weekly, daily, and once we tap into that weekly, daily zones, then you zoom in and start to do the same thing on the 4-hour, okay, inside that zone. So we tapped into our confluence, our key level, on the 4-hour. So what are we looking for? We're either looking for 50 EMA breaks, green vector break, and or break a structure, or also W formations, continuations, and stuff like that, right? So if we're in a downturn, what are we paying attention to? We are paying attention to the highs because that's the only way to break structure if we break the highs. So move up, move down. This is the nearest high. We SFP this, but we didn't confirm a break because there's a move up, move down, move down, move up, move up, move down. We broke it right here. This was a full candle close. So let's see if this was even an SFP too. Let's see. So look at that. So it's a 2 candlestick pattern. Move down, move up. SFP, nearest high. We broke structure. So now you could have gone long right here, invalidation here, and target the nearest high. up here, which would have been a winning trade. But now, once you get here, now if we are rejecting down, we are looking for a continuation because this is still trending down. So to really confirm this is a break and we're going to go higher, this is where I would start to look for a fit. What is the 50% of here? Okay, we tapped the 50. Let's see if it's going to continue. So right here, I let it play out so you could visually see how the price action moves. But you will never know what's going to happen. This is why you need to get clear validations or clear terms, right? This was the new low, new high. What was the 50% retracement? If this was going to continue higher, we're going to go back to the 50, wait for a structure here. What is structure looking like? Of course, there's a W here. Technically, this could have been a W because 1, 2, 3, 4 W, but it touched down, but it went down here. But to invalidate a level, what do we need? A full body close. If you did went on the logic of going long here because you saw the W break, this low would have been your invalidation. But as you notice, it just wicked it out. And if you would have saw this consolidation, this would have showed that it's accumulating to attack price higher. So in all reality, this was a attack liquidity, rebalance, continuation to attack liquidity higher. Okay, we move out of here. We already tapped to this bearish order block. Now you want to look for the new one. Okay, already touched it. This is the one that has not been tapped. Remember, it's the move up. This is the move down, move up. This is that low, move up, move down, up here. We tapped into this bearish one. So now what we're looking for is price to close above these highs, this high really, which it didn't. It did also have an SFE. And did have a break right here. A very minor, small, and these are always the best ones because watch, when you see tight ones like this, pause. These are amazing trades because you see this huge move up. Remember, where is liquidity? Because not something you need to pay attention to when you enter a trade is where is liquidity, and why would I want to look for a short here? Because we are clearly ranging, right? If we're above the macro 50%, this is all discount, right? Now let's mark a new range. Since this is the new low, you could still use this macro 50, but now this is your new range right here. Even in the new most recent range, we are still in premium. So with the logic of discount and premium, this is theoretically by probability a really good place to short, which is a good high probability chance it will be in profit. But when you see moves like this, when you see just clear, just if you could make trend lines, pretty much, if you could have trend lines like this, there's a lot of liquidity, right? All this right here is liquidity. So this is also a good way to target down all the way, continue lower, and I don't want to get too deep into this because this is going to be confusing, but to make it very clear, I think this is what you guys should do because now I'm getting way too ahead of myself. This is like day trading and like a little bit too much. So let's say we're here now, no trade. What do we mark out? All-time high. We are on the daily time frame. This is significant low. Um, significant low. We have that macro imbalance right here. all-time highs. We had a bearish order block right here. We're currently in a bearish order block, so now this high needs to stay. We need to stay under this high to confirm that we're going to go lower. What is the nearest low? Down here. We're at imbalances, order block. There's an order block right here. This is the last move down before the move up. Boom. There's a bullish order block. So this low should be safe. Right now, what is price doing? It's attacking liquidity to the upside, but we are clearly in a range, so we are accumulating, we are generating liquidity, and we currently attack liquidity to the upside. We rebalanced because this is a pullback. Now, what are we waiting for? Are we gonna see? Are we gonna? Was this a rebalance to go lower? To go lower, or was this a rebalance to go higher? Structure is currently doing the continuation pattern. As you can see from the lows, we are doing the continuation pattern. So what we want to see is another continuation. Boom, boom, like this to validate this is it. Or if we're going to go back to the low of the range, because we trade from range low to range high, we want to see a M. Are we going to see something like this? There's liquidity here, imbalances have liquidity. We identified where the liquidity resides. There's all liquidity down here. These are ugly. We could do a trend line. So that means there's huge amounts of liquidity down there, especially a steep trend line. So now in this moment, I wait either for this high or this low to get tapped. But in all reality, where I will wait to get into a trade would be at the 50% range, which is down at these lows. So in all reality, this order block is probably the next area I will look for a buy. But I'm waiting till one of these to get hit. Let's see. Okay. Now look what happened here. This was, let me make it big. Did we tap it? Yes, you see? We had a wick. What is that? SFP. Low right here. Boom. Confirm break to go lower. We're going into the order block. We're not ready to go higher. Boom, completely just blasted through this. We had an SFP. So at this moment, this would be a moment where I'll be like, you know what? Let me look for a buy because we are consolidating. We had the SFP. We took this liquidity down here. So I will zoom into the 4 hour. Okay. I will zoom into the 4 hour. And I'll do the same process what I did on the daily to the 4 hour. So identify structure, what's happening. We're obviously in a downtrend. New structure looks like we're making an M formation. Looks like we are making an M to possibly retrace to go lower. We swept this, so now the new range is here because we can't talk about going higher unless we close above these highs to attack here. We tapped the 50% of the range. We are in premium, we're in discount. So if I am anticipating that we're going to go lower, I would not buy. If I was looking like, you know what, this is good, I'm not buying here. I'm waiting until we get down here to give my odds a higher chance. And if it's not in my favor, my loss would be less. But if you were looking for a short, this would be not bad either. Because now let's say you're looking for shorts. Not only are we in premium, but if you look at structure, we've made a clear M. We broke structure to the downside right here. We broke structure right there. And we tapped into the order block right here. So now you could open up, oh, wrong thing. Let's say I want to go short here. What I would do is I would personally do my stop loss above these highs. Actually, what am I doing? This is the new above the range high. I would enter 20%. My next 20% here, last 20, and I'm not putting my 60, my 40%. I'm not doing it unless I see a explosive move up, tap into this bearish order block, and reject down. Then I'll add my 40% there, or I'm not gonna add a 40 until I see a break of this, retest, and lower. Okay, so let's see what happens. Right now, I got my first 20% in. Oh, let's see. Look at that. Now do you see why you're gonna be wrong most of the time? But do you see why I do the entry model like that? Remember, I said I was gonna put 20, 20, and save my last 40 for when we tap this whole imbalance and order block right here, which we did, and now you would have profited off that move. Okay, but if it kept on going higher, I would have only had 60% of my margin in there. And I'm showing you off straight price action. I was going to show you with vector candles and 50 EMA, but I don't know why it's not showing up right now. Let me see if my 50 EMA is showing up. Oh yeah, if even with the 50 EMA, if you had the 50 on, you would have noticed that we broke above, created an information. Remember, if price is going to reverse down or going to go down, you always see M's. At the bottoms, you're going to see W's. At the tops, you're going to see M's. Okay? Even right here, you technically saw a W, boom, but it wasn't a continuation, but it was still a W. M, 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 little mini M, W. But now, since we closed underneath here, we're waiting for the retrace continuation. There you go. We got the retrace back, continuation. This would have been a monstrous short. So now let's see how it looks like on the daily. New trade. Let's say, boom, we had that trade down, it was successful, we closed it all the way. What are we looking for now? What happened now? Boom, boom. What is your new bearish order block? That tapped into that, tapped into that. This is no more your new low. This is your new low. This high is your new high for a daily break of structure to the upside. So once we're at an extreme like this, where it's clearly we are at the very bottom, what I like to focus on when we are, and to know that you're at an extreme discount is, let's say we have this tool, bring it down, if we're underneath this middle level, which price did. And on the daily, this is a W formation right here. And what do we look for? At the bottoms to see if price can go higher, is W's. So now I will wait for this high to get closed above on the daily to confirm to go long. Did not go long, we SFP'd. Boom. But now let's zoom in what happened here. I wish the vector candles was working right now. I don't know why it's not working. Let me see if I take this off. That is so weird. Why is it not working? Okay. We were right here. Yeah, okay. We were right here. This was where we were at. By just using the logic of the vectors too. We're going down, we're seeing green vectors at the lows underneath the 50. Remember, the market maker is going to buy at the lowest point possible. And even with that rejection that continued lower, yes, we did get a green vector break on the 50, but once you saw this, you would have got out immediately. Okay? See a green, boom, boom, boom. But also, even here, if you were sticking on the 4 hour, you would have noticed boom, boom, break because we close above this high, retrace, continuation. Bringing it all back together, the strategy is four things: identify structure, locate liquidity, find what price did and what is currently doing, trade towards liquidity or trap price. And price either does three things: it generates, attacks, or rebounds as an imbalance. Always go on the zoom out, look at the higher time frames, and mark out the highs and lows, and use that structure to see where is your ultimate high, ultimate low, and then zoom in. And from inside that high and low, that's when you do structure again. Zoom in, that's when you do structure again, and you mark out your lows and highs. The higher the time frame, the more weight it has. Your confluences are your key levels, which is your highs, lows, order blocks, volume profiles. Really basic rule: only long in discount and only short in premium. And I know you saw right here, the premium was all the way down here, and it only was, I mean, discount was only a little bit amount of time. But you could also make this, because this is now current range or local range. You know, let me, okay. Because originally it was here and it only did a small amount of time here. But remember, the higher the time frame, this was a huge leg up, and then that means whenever it gets to discount, then a lot of people that were in that position are going to want to buy on discount if they're expecting it to go higher. But if you really want to get in and you're not sure, let's say like you're in here, right? You're in here and you're like, but wait, it's still in premium on the higher time frame, but I really want to get a trade that looks good. Then just look at your nearest low. This is your nearest low, nearest high. From there, you are still in discount, meaning look for trades in here. When you see a break of structure, get in, but don't look for any longs here. When you're up here, look for shorts, okay, or take profit. And for the volume profile, even when this leg up, before, I can't show you in the replay because I don't know why the volume profile doesn't allow it to. But let's say we only had this move up, you would have noticed in this imbalance where price did find its low, because this was the imbalance that was the low and created this huge move up, right? This was the last low. You would have saw like, oh, okay, this imbalance is really strong. Remember what I said? You want to look for a lot of things to align together. Not only did you see vectors breaking out of here and going into it, but a lot of contracts got transacted there. So this was obviously always going to be a huge zone of interest. Okay, but even with the wrong profile, let's say we're here, we are here. This hasn't happened yet. If you took it from the high and the new low, because now this would be, hold on, here. What is this telling you? We tapped into that POC that used to be there. Obviously now it's not there no more because it's following from all this price action. So now the new contracts are up here. Most of the contracts got transacted up here now. So for you, if you're in premium, you have to wait till you reclaim this low. And remember, once you reclaim a low or a value area low or high, it tends to start trading towards the value area high or to the PLC. And if you just follow the price until it broke out, how did it look like at the end? It looked like this. The PLC moved to down here. Once price got to, let's see, I can't show you extended because if I do it now, it's going to take all of this. But when you have it at the extended um, setting on there, it's going to be updating as price develops. But as price is developing, let's say we start from this low, there's a POC. Let's say once it makes a new high, which is right here, once it makes this new high, the POC now got lower, rejected. We went down. See what happens here. The value area low is going down with price. We start going up. We made this new high. Now price is above the value area low, and we had a break of structure and a 50 EMA break on the daily with the vector candle. We're going. We went to the POC, consolidated, and trading above. So now the logic is that we're now getting ready to attack here. Use the volume profiles as price is developing to see where value is switching. Pay attention to the PLC. If you're above the PLC, target the value area high, or below the PLC, target the value area low. If price is under the value area low and it reclaims it, that's a very strong sign. If it's above the value area high and goes down, meaning it stays below like this, we go high and we stay below, it's really bad. That means we're going down to the value area low. You can start opening your trades targeting the low. If we break above and stay above, and then we're going to go up to higher prices. Okay, not DCA. I don't recommend you guys to DCA up here. Don't be like, oh, 20%. Don't do that. It's better to start your DCA once you're at the 50. So if you're up here, it's going to take a lot of discipline. But if you have no money in, then it would have been good to take, like, for example, right now. Let's see how it plays out. If you guys follow me, then I'll come back to this video and see how this DCA will play out. I would not DCA until we are at the 50 because it might be a tap continuation. 20% here, boom. Until we recover this recovery, because we have a recovery point here. I'll put 20% here, last 20% here, and for my 40%, which I don't, if Bitcoin gets down here to this recovery point, sheesh, if Bitcoin doesn't reverse from here, then it's cut, it's done. It's done for. I don't think which is a big fugazi, but obviously not. That's not what I think. I think this has legitimacy, and on the long term, I think it's going to go higher. Maybe in this year, no, but on the long term, it's going to go higher. Save my last 40 here. But this is on the weekly time frame. So this is more on an investing thing. So you're not going to see a return on this until months, maybe 2 years later. Obviously, this is for if you're investing as a swing trader, then as a swing trader right now, it wouldn't be a bad idea to start opening up a position now, 20% here. Again, remember, my validation is this low. So I do have a position I'm building up right now. So 20, 20, 20, and then wait what happens to this on the macro. Wait until, let's see on the monthly time frame. Because there is a reason for price to wick out, right? And remember, it has to be a full body close. So this could happen. There's a recovery here. You could quickly wick this out and start recovering up. So I have 20, 20, 20, and now I'm saving my last 40 for this. Boom, big quick recovery, last 40, okay? So if you could match fundamentals with this, you're gonna get way more higher probability setups, okay? So we look for market structure, what it's currently doing, liquidity, find what prices did and is currently doing, and trade or build trades to track price, okay? Confluences are your key levels, your zones of interest of where you're going to look for a trade. Your confirmations is your breakout structures, vectors, like the EMA break, and like W's or M's. Continuation is your 50% pull, your Fibonacci, or your retrace continuation pattern. price does three things. It's either generating, attacking, or rebalancing an imbalance. And for you guys as a beginner, break up your account size to lives, have a fixed amount before you press buy or before you even put risk down. Know how much you're going to lose, because that's the only thing you could guarantee. You can't guarantee a profit, but you could guarantee how much you're willing to lose. Um, get market experience as much as possible, okay? Um, in the beginning, that's something you cannot get taught. You can't read. Doesn't matter how many books you read. It doesn't matter how many videos you watch. You cannot learn that. Best entry model is the SFP breakout structure at the highs or lows. When you get your confirmation, you're looking for pretty much a continuation pattern. The rise retrace break, that is the pattern that you need to learn. I recommend all you guys to train your eyes to see all these M's, W's, break, retrace, continuation. Train your eyes to see that. So when you see it developing, you know what to do. You know what you're looking for. Okay. Do your analysis on a higher time frame. Once the price goes into your higher time frame areas, zoom in and do the same analysis, the same as in mark out your structure, mark out your confluences, wait for your confirmation, all that. Do it on the lower time frames also. And then for your risk management, I recommend to do the 20-20-20-40 method, just so you keep you in the game longer and preserve your capital as a beginner. And also for your account size as the beginning, do small. Don't do like $10 per trade. Don't be over here don't try to make money, because the more you try to make money, the more you're gonna fuck up, and then when you lose it, you're gonna hate it and you're gonna quit. The main reason why the statistic of a lot of people quit is because they can't handle it, or they lose too much, they're over risk, or they're too focused on making money rather than the process. If you focus on the process and the entry, then it's gonna come, right? Most importantly, you need market experience. You need to have risk. You need to trade. You need to put the risk down. I'm not saying demo trading or backtesting is bad, but you're not getting that real human emotion on how it feels like to have money on the table, okay? You can't teach that. And the data that you guys should analyze as a beginner, as I know I'm saying that as a beginner, you need to lose as little as possible so you gather as much data. The key points that you should gather is how you were feeling, what are the confluences that align together, what was market doing, what was your bias, as in like did you think it was going to go higher, lower, and also if it's a winner, pay attention to how long was it open for. Pay attention to when you took profit. Maybe you notice that, oh, beginning of the week is usually bad. If I open up a trade towards the middle of the week, then it usually bids a profit, but ends up being a loss because I don't take profit or I don't put my stop to break even. Just, you need to gather as much information about you and how you react, because some people are the type that are not afraid to just go in as soon as they see it. Sometimes maybe you don't need to wait for the, like with my step process, how you get the confluence, confirmation, continuation. Some people just see confirmation and they get in there, okay? Some people see confirmation, then they wait for the continuation, as in they don't get in right away. They see the breakout structure, but they wait for that pullback to get a safer entry. You could be that type of person, or you could be the type of person that just shoots from the hip. You think it's going to come here, so you get in light, and once you see confirmation, then you put in the rest of the position. So it really depends on you and what your personality is. Um, but yeah, I hope my whole goal, or that I wish I accomplished with this course, is to get you guys mostly to see how I'm talking about it, see how I'm breaking it down. And my examples, how everything I say is, if this happened, then that. If I don't see this, then this, okay? But if I had to really break down the main aspects, is that follow market structure and zoom out, okay? Only buy in discount and only sell on premium. and always know how much you're gonna lose. I think that is the main key points to, for at least for a beginner, to get the foundation to be able to learn this better and stay in the game longer and not get stressed out and not be the average person that just quits because it just sucks. It just sucks. You keep losing, and you're. Hello again. If you see me, then that means you watched the video all the way through, which is I appreciate you, but damn, that was rough. I apologize with this video. There's a lot of so's, a lot of ums, and I could have definitely explained things better. But I want you guys to keep in mind, this is my first video of me talking about this type of stuff out loud. To me, it makes complete sense because that's how I convey it in my head. But I did this all in one take. I did not do no retakes. All one. Pretty much recorded everything in 2 days, and then everything else took from editing the fat out, editing. Yeah, I edited a lot of stuff out that was too much, or I was just yapping and kept on going. But to make a long story short, I appreciate y'all, and I rewatched the video, and I did leave everything you need to be able to trade. Okay, now what's next for you guys is to understand fundamentals. You have to know the two. And if you keep following me, I'm gonna go over all that. My content's gonna get better. My explanation is gonna get better. So hope you guys keep following me in this journey, and then I could help you learn this stuff as the best that I can. But I will really appreciate you guys if you guys gonna keep following me. If comment on my YouTube, message me through Twitter. I might have all my links below. And talk to me of which parts of the videos you want more explaining on. That's perfect future content ideas. So please do not feel embarrassed to hit me up or anything, okay? I want as much feedback as possible. But other than that, I'll see you guys on the next one.